All right. Welcome, everybody. Welcome, welcome. My name is Dana Sparks. I am the director of the Georgia Real Estate Academy, which is the entity offering this course for CE credit. And I just want to welcome everybody. We're really excited to be able to make this course available to agents, as I said, through this virtual transmission where a lot of agents may not otherwise have the opportunity to take this class. So welcome. Just like any CE class, there's no recruiting, even though we're virtual. So we're all here. We have a huge philosophy in training and education of all agents, that it helps all agents, it helps our industry, and it helps our public. So we do welcome agents from all areas, all brokerages, and we're just really excited to be here, for you guys to be here. I am going to share my screen, and I am going to share with you guys this is where you access the chat. At the bottom of your screen, you'll see a chat button and it'll open up the chat. Make sure when you are typing in your information, you're sending it to everyone. If you do not see this little chat balloon, you will probably see 3 little dots that say more. If you click on that, then you should see the chat balloon. So again, welcome. This is the notice to students for the virtual broadcast of this CE class of a GREC approved classroom class. The Georgia Real Estate Academy, which is GREC school number 6915, with the end date of renewal being December 31st, 2022, presents the following course of study. FHA Financing 101, it is GREC course number 65973. This is a virtual remote broadcast of an approved in-class course for 3 hours of CE credit, no requisites for this class. The instructor is Jay.Alexander of Homestar Financial Corporation, and his NMLS number is 223779. There is no homework and no exam. You must stay on the Zoom broadcast for the entire duration of the presented coursework. We will do roll call through the chat function, as I've mentioned, and after break, we are going to do a course evaluation through a poll. So I'll explain that when we come back from the break. Students may only receive credit for a specific course number once every 12 months. If you have already received credit for this course within the last 12 months, you are, of course, invited to stay, but you won't receive additional credit. So you guys, that gets confused by a lot of agents all the time. You can take as many FHA financing courses as you want within 12 months, but you're only going to get 3-hour CE credit for any specific course number. So if you take another FHA course tomorrow, offered through a different school or even through this school, but a different course number, you will get credit for that. However, you're only going to get credit for this specific course once every 12 months. I get a lot of questions on that. Again, prohibition of recruitment. There's no recruiting for employment opportunities for any real estate brokerage firm in this class or on the school premises. The school premises is loosely defined through these virtual classes. Report promptly any effort to recruit on behalf of a brokerage firm by anyone, including a fellow student, to myself. I am the director of the Georgia Real Estate Academy. My name is Dana Sparks. There is my phone number, or the coordinator of the school is Heidi Kelly with her phone number. These are our email addresses also. CE credits will be recorded within 3 to 5 business days after the conclusion of this class. Again, with these virtual classes, there are 4 reports that we have to amalgamate together to come up with a CE roster to put together. So it does take a little bit of time. After, and Heidi Kelly, the coordinator of the class, does put those together. After the, I forgot what I was going to say. Oh, after we record the CE classes, I will let you know that we do not contact you to let you know the classes have, the credits have been recorded. You have access to all of your CE credits. You guys all have your own login to the Georgia Real Estate Commission. If you have not logged in since December of 2019 when they changed over their website, you'll have to create a new login, and all that information is on GREC's website. Or if your license is active with a broker, your current broker through their brokerage login also can access all of your CE credits and see what you have credit for or not. So again, we are not going to contact you after they have been recorded. Just check your own GREC login or ask your broker to check your login to make sure those classes, this class has been recorded, and again, 3 to 5 business days. All right, I am going to hand things over to our instructor, Jay.Alexander, and we will get started. Again, any questions, please type them in the chat, and we will go from there. All right, Jay, you are on mute, but you should see the host function. Do you see it, Jay? You're on mute also.
There we go.
There we
Sorry,
go.
guys, having some, of course, technical difficulties here as soon as we try to get started. I apologize. Give me just a second. My whole computer sets up through a USB port that got unplugged about 3 seconds ago, so everything went out. So y'all give me just 1 second. Let me get this moved around the way I had it set up before. All right. There we go. Gracious. Still learning how to do the whole Zoom thing, guys.
Also, why don't you introduce yourself and let everybody know your experience, your background, who you are, and all of that good stuff.
Absolutely. So let's click this button. Should be sharing the screen now. Can everybody see some PowerPoint slides, FHA financing? Let's see here.
Yes, Jay, we see it.
Perfect. Okay. So guys, my name is Jay.Alexander. I'm with Homestar Financial. Got the chat up here on the screen as well, so we can try to monitor that as we're doing this class. I am a loan officer, been in the business for over 13 years now. That's hard to believe. Have a chemical engineering degree with Georgia Tech, so go Jackets. And if you're a Georgia fan, please don't hold that against me. I have 3 handsome boys and a beautiful wife. I play drums and run the music at my church. I coach my kids' baseball team. And that's me in one slide. That's my whole life. I really don't have time to do anything else. So there you go. And guys, want to make sure everything is working here. Let's get a screen up. Let's see here. A little frustrating. And guys, I do apologize. I promise I had this all ready to go and exactly how I wanted it, and then I lost control of my computer here. So let me shrink that down, and chat box. There we go. All right, so make sure the chat box is working. For those of you on a computer, I know it's tough if you're on a phone or whatever, but real quick in the chat box, tell me what's the one thing you've looked forward to doing or that you're doing now outside of quarantine that maybe you weren't doing before. Let's do that. Have like a fun little poll here real quick. See what we got going on. I know my boys and us, we've just been excited to get back out to eat, to not have to cook or come up with something or bring stuff in. What do we got here? Netflix. Yeah, we've got to do Netflix either way, right? Quarantine or not. Headed to the beach, running, traveling the countries, out to dinner. Totally understand. Hopefully life's getting back to normal for everybody here. Hey guys, and then also just so you know, we get asked this a lot, and Dana, I think you posted this, but I set up this link, tinyurl.com/FHA form. If you guys will visit that website and complete that form for me, I'll have a record and I'll make sure we email you a copy of all these slides, okay? And don't feel like you have to get this now. We'll put this up on the screen a few times. But just know that if you complete that form for me, that's the way I can have a better record than trying to grab it out of the chat box here. And we'll get that information out to you guys and make sure you have these slides and any of the coursework and course information, okay? So this is the FHA 101 class. Like Dana mentioned, I've been in the business a little while, work with Homestar. And we close lots and lots and lots of FHA loans here. And what we want to do is want to cover just some of the basic things we're going to be reviewing. First of all, we are going to cover just some basics with FHA guidelines and rules and how it works. Updated some of these slides this week to discuss COVID-19 and the quarantine and the shutdown and how that's affected the FHA loan program. So we'll discuss that and some of the details that I think as a real estate agent you need to know. We'll certainly explain how these loans work on HUD homes, and we'll learn how to set expectations regarding the customer's cash to close and the money needed just during the process for both standard FHA and for HUD REOs and HUD homes and things like that. We'll discuss repair escrows and how that works. That's a great way to save a deal and save transactions that a lot of times people don't know about. We'll discuss some changes that have happened in FHA guidelines, not just due to coronavirus and COVID-19, but some changes before. And we'll review some basics of 203K financing, and we'll want to make sure you have a comfort level with FHA financing for your buyers and sellers. At the end of the day, if you understand FHA, I think you'll have more clients, and obviously more clients should lead to more commission and more money in your pocket. And do y'all see these little red drawings here on the screen? Is that just me? Maybe in the chat box you can let me know. Good question.
Jay,
can you stop?
Jay,
Yeah.
If you hover your mouse at the top where you've got the you've got the Zoom controls. Do you see where it says? Okay, I don't have them now because I'm not the host. Do you see where it says enhance or draw or edit or something like that?
Clear all my drawings. How about that? There we go.
Yeah. Okay.
Right.
Yeah.
Good deal. Sorry about that, guys.
Okay.
I don't know why I had a draw on here. Let's get back off of that. All right. So, so this is my real estate postulate. If this traces back to my engineering background, a postulate is a statement that can't technically be proved, but it's assumed to be true. And a postulate, my postulate for real estate is that the characteristic that causes the greatest increase in a real estate agent's commission is a lender that truly knows the FHA loan program. And the reason for that is, guys, FHA is far and away the most aggressive loan program available in the market as far as customers that have recent foreclosures, recent bankruptcies, they have struggle with income or debt to income ratio rules. And we'll get into all that. But long story short, FHA is going to be the best way to get the majority of your challenged customers, your credit challenged customers, your income challenged customers into a home. So I think it's very important to know this, and I really think that we can, help your business and make sure that you're getting every possible client financed and approved and closed by having a better understanding of FHA and how it works. Now, with that said, guys, before we get into the actual meat of this presentation here, in the chat box, please, if you have any questions or if anything comes up, please type it in. I do my best to try to cater these classes to the information you need and questions that you have, and want to make sure we're getting those questions answered as we go through the class. So don't hesitate, definitely get it in there, and I'll do my best to monitor it and get all your questions answered as we go through. So first piece here, rules, guidelines, overlays, and risk management. I want you to have an understanding in general of how FHA works and how Department of HUD manages the FHA loan program, okay? So first off, the rules and guidelines for the actual loan program are provided by the Department of HUD, Housing and Urban Development, and they have what they call an FHA Mortgagee Handbook, and it's now labeled the 4000.1. And you can Google that, you can hop online and just Google FHA 4000.1, and you can pull up a copy of this guidebook as well. They don't keep it under lock and key. It's not hidden. It is about 1 million pages though, so just be aware that it's going to be some tedious reading to try to get to the section you may be interested in, but it's out there and it's available. Then what happens is, so the HUD publishes the handbook, and then as lenders, we always have questions, and there's always updates and things that are G letters to either clarify or update certain decisions or certain rules inside the FHA loan program. And again, these mortgagee letters are available online. There's usually 2 times a month we're having some type of change taking place with the FHA program. Then approved lenders, we underwrite FHA loans, and we close FHA loans without any type of review or approval from FHA or from Department of Direct Endorsement. We are really any other big mortgage company that you know of. We speak directly for Department of HUD. Okay, so if we say yes, then they'll approve the loan, but we are responsible for the loans that we approve for the FHA loan program. Okay, let's see here. I've got some people talking about sound issues. Let me see if I can try something here. Y'all bear with me 1 second. Sorry about that, guys. That's one of the things I think I was trying to fix before I messed up my screens right before we got started. Let's try that. Hold on 1 second. Let me check something. Check this. And guys, I do apologize for the technical difficulty here. I haven't done one of these classes from this location yet. All right, so let's try that for a minute. Tried to go into more hardwired internet connection, so maybe that'll fix it. All right. So what happens is lenders, we're allowed to put any type of individual guideline or overlay on top of HUD standard rules in order to manage or mitigate risk inside the FHA loan program. Okay. So, and there's lots and lots of examples of this. Okay. But the reason that's so important and the reason they give lenders the ability to do this is that HUD can actually terminate our ability to underwrite an FHA loan. They can terminate our underwriting authority for FHA, okay? So if what happens is HUD actually reviews a lender's default rate every 3 months, and 1 30-day late within 12 months is considered a default. And then the HUD, they actually review the default rates in specific geographic areas because they understand if you have, you know, something that takes place, say like with water in Flint, Michigan, that you might have a higher level of defaults than you would have in other places. So you're measured against your area. But understand, Atlanta, we're a pretty big banking hub inside of the US, and we're compared with some of the bigger lenders in our area like Quicken and Wells Fargo, who aren't very aggressive when it comes to FHA. So it makes it real interesting to be an FHA lender here in the Atlanta metro area, because you're competing against some banks that do a lot of loans and they don't have a whole lot of default because they're so conservative. So it keeps it interesting, but we are compared against them. It's called our compare ratio, and we have to make sure that compare ratio stays in line so we don't lose our ability to close FHA loans, because there's a word we use to describe FHA or mortgage companies that can't close FHA loans. They're called bankrupt. Okay, they don't really exist. You can't. It's hard to be profitable without closing FHA, in my opinion. Some basics here about FHA. There's all kinds of FHA loan programs available: 203B, 203K, 221D, 234C, all this kind of stuff. The main one that you're probably familiar with is this one right here, the 203B. This is your standard FHA purchase loan. 203K, you've probably heard of that. That's the FHA renovation loan. These other programs that are out here, the 203 or 221D, 234C, those are lesser known programs. 221D is the one we use for multifamily properties if you have a 2 or 4 unit property. 234C is actually for condos. 245A is a graduated payment that no one closes anymore, where your payment actually escalates the first 5 years you're in the mortgage loan. So just be aware, there's lots and lots of programs out there, but it's not the main one that we're going to be interested in discussing today. Is 203B, which is your standard FHA purchase money loan. Okay, the minimum down payment for FHA is 3.5%. This does have to be the borrower's own funds, but gifts are okay, because if a customer receives a gift, well, obviously that's their own funds. Okay, FHA does consider getting a gift an added layer of risk, can make it more difficult to get our customers approved, but that is an acceptable source of funds to go towards the down payment. FHA allows up to 6% of interested party contributions. I put interested party on there because I get a lot of questions from agents. Hey, can I cover some of the customers' closing costs and things like that? Well, as long as between what the agent is giving, what the lender's giving, what the seller is giving, as long as that all adds up and it's less than 6% of the sales price, then it's allowed. Anybody that's considered an interested party obviously is going to count against that 6% max for closing costs or a closing cost contribution on an FHA loan. Okay, and then FHA does have two different types of mortgage insurance. They have the upfront fee, which is 1.75% of the loan amount. You're probably familiar with that because that's what goes on your FHA contingency form on your contracts. But then FHA also has a monthly fee. It technically varies, but it's usually 0.85% of the think of it as 0.85%. And the best way to think about that is if a customer has an FHA rate of 4%, once we add in the mortgage insurance, that rate is effectively 4.85%. Okay, so the mortgage insurance is almost a direct adder to the interest rate or the effective interest rate that the customer is paying. We got a question here from Elise. Can investors use a 203K loan? A good question, and we'll get to that more here in a second, but short answer is no. FHA is an owner-occupied loan program, so it's not eligible for investors. Couple more things here. Income for FHA must be stable. We're looking for a 2-year history of our 2-year work history, and we're looking for income that will continue for 3 years. So for customers that work a job, the way we try to figure out if their income will continue for 3 years is we look back on the previous 2. If you've worked consistently over the last 2 years, then we're going to assume you're going to continue working for the next 3 years. For other types of income, though, say child support income, or if a customer receives, monthly payments through disability payments or something like that, or say they pull money from retirement and they want to be able to use retirement money or money from a 401k to purchase a home, that's fine. We have to document either that the child support will continue for 3 years. We're going to ask how old is the child that you're receiving the child support on. If it's a retirement income, we're going to ask how much money's in your retirement account. Can you continue pulling out $2,000, $3,000 a month and still have enough money for that income to continue for a further 3 years, things of that nature. FHA requirements are extremely flexible, and this gets back to my statement before. We said that lenders are allowed to put in overlays, and every lender has some type of overlay. In the chat box, anybody want to guess what FHA's minimum credit score is? What's the lowest credit score that FHA will finance, or what they'll go down to? 640, 640, 580, 580, 640, 650, 600. All good guesses, everybody. Janice Carter, maybe you sat in my class before. You get the gold star here. The correct answer is 500. According to HUD's guidelines and their rules that we talked about before, they will go down to a 500 credit score on an FHA loan. Now, better question, does anybody know any lender that's lending to people with a 500 credit score? I'm willing to guess you do not. No lender is in the market of lending to people with a 501 credit score because those are not good loans, okay? Those are high-risk loans. They typically don't perform. And remember, if the loan doesn't perform, that goes against us on the lending side, against our compare ratios and our default rates with Department of HUD. So every lender has some type of overlay with credit score. At Homestar, we went down to a 580. Technically, we'll still go to a 580 with exceptions, but we're actually really at a 620 right now because of coronavirus and COVID-19, and we'll talk more about that here in a few more slides. But just be aware that that's a great example of how overlays play, and it's why, as much as I'd like to tell you that you really only need one lender and that's me, you probably need to have a handful of mortgage lenders and people that you trust that you can bounce information off of, because every lender is going to have their own separate rules and separate overlays that may or may not impact the customer you're looking at getting into a home, right? a perfect example is I had an agent call me one day, and she was like, hey, I've got this customer and they're ready to go. They're just trying to save up some money because they're doing FHA and they can't get a gift. And I was like, they can't get a gift? What do you mean? So, oh, I mean, I know you can get a gift, but their credit score is kind of low. And because their credit score is a little bit lower, they're not allowed to get a gift on FHA. And I was like, what are you talking about? And the lender that she was talking with, not a bad lender, not a bad person, but they had an overlay for customers below 640 credit scores. They would not allow that customer to receive a gift for FHA financing. That was their overlay. We didn't have that rule. We discussed it. We figured out what was going on and turned around and closed that loan in about 30 days. Okay. So just know that, just be aware that there's always going to be overlays and rules with different lenders, and knowing how that works can a lot of times help you ask the right question. Is this a HUD guideline or is this a lender overlay that we're working with or working through to try to get this file approved? FHA does have seasoning requirements for major credit derogatories, like every loan program does. These are extremely aggressive. FHA requires 3 years after a foreclosure, 2 years after a Chapter 7 bankruptcy, 1 year after a Chapter 13 bankruptcy, as long as the customer's been making all their payments on time. And then finally, technically their guideline says there is no waiting period on a short sale. But I love this. They say there's no waiting period on a short sale if the customer doesn't have any mortgage liens. Well, that's comical because most people can't get a short sale approved unless they have gone late on their mortgage, right? So if there are lates and they short sold the property, then they have to wait 3 years. It's the same waiting period as a foreclosure. But again, at the end of the day, these guidelines and rules are pretty aggressive relative to other loan programs, especially the conventional loans and stuff like that. Currently, the loan limit for in Metro Atlanta for a 1-unit property is $401,350. So that's your maximum loan here in the Metro Atlanta area for an FHA finance property. What this means is that you can buy about a $416,000 house, put your 3.5% down, and be right at the maximum loan amount allowed for FHA. Lisa, great question. Do I have handouts? I don't really have handouts, but and I'll put this link back up on the screen. But there's a form you can fill out, and I'll make sure you get a copy of these slides. And I think I sent a link out to Dana as well, and she's got that posted. We'll make sure that people have access to these the slides and the information. So don't feel like you've got to write all this down or take screenshots of everything as we're going through it. We'll make sure you get this information. So maximum loan limit is $104,350. Some basic requirements people just need to know. Borrower must be a legal U.S. resident or a permanent resident alien. Borrower must have a clear credit alert verification reporting system number or a clear CAVERS number. You may not know this, but you have a CAVERS number. I have a CAVERS number. Everybody you've ever spoke to has a CAVERS number. CAVERS is how the federal government keeps, or just one extra way, I guess we should say, of how the federal government keeps track of you and how they determine if you owe them money. So customers that say are in default on federal student loan debts, they will have a claim on their CAVERS number, and they're not going to be eligible for FHA financing until they clear up that student loan derogatory or that student loan claim on their CAVERS number. Another good example is I had a customer who was in the military, and the military had way overpaid him on some VA benefits. I think he was supposed to get a check for like $2 grand. He got a check for 20 grand, and they were making him pay back the money that they had given him in error. So he had a claim on his CAVERS number. He owed the federal government that money. Customers that are way behind on their income taxes, they'll have a claim on their CAVERS number. So those people are not eligible for FHA financing until we get that cleared up. The idea is that if you owe the federal government in one area, we're not going to give you money or make funds available to you from the federal government in another area. Federal tax liens can remain open if the borrower has arranged a payment plan and made at least 3 on-time payments on the tax liens. Be aware, guys, that this is very important. This is only tax liens where this rule applies, okay? I'm talking to a customer today. I actually spoke to him last night. We're getting his application today. He was told that he could not buy a home for 3 months because he owed the IRS money. And I asked him, well, said, do you have a tax lien? He's like, well, no, I just filed my taxes and I owe money. That is not an FHA rule. That's an overlay from his lender. They're saying he has to make 3 months of payments on time to the IRS. We don't require that. It's not a tax lien. It's not an FHA rule. And we're going to, we certainly have to qualify him with that payment to the IRS, but he doesn't have to make 3 months of payments. We can just verify that he has a payment arranged and a payment set up. We'll qualify with him and we're going to get him closed again in about 30 days. He's already under contract. So know that for tax liens, it's 3 months of on times. If it's just taxes owed, there's no requirement of 3 months of on time payments. And if you do have a customer that has a federal tax lien and they've got to make 3 months of on time payments, and we know that, let's kind of think through this. How long is it going to take before this customer is eligible to actually purchase? Most people would say, oh, well, you got to make 3 months of on-time payments. It takes 3 months, right? Well, let's kind of think about that. Let's say you refer a customer to me. I take a loan application. I see that they have a federal tax lien. I ask them, Mr. Customer, do you have a payment plan arranged for this tax lien? No, I don't. Okay, well, can you go set up a payment plan today or tomorrow? And let's say they do that and they go ahead and make a payment. Well, they can make their first payment immediately. Then they can wait a month and make another payment. And then they can wait 1 more month and make the third payment. And now they've made 3 payments, but it only takes about 2 months to get us there. See, you see what I mean? It's about a 60-day process. And most people, from when you start the loan application to looking for homes, finding a home, getting a home under contract, getting it closed, it's about a 60-day process anyway. So this is really, even though it's something we have to do and something we have to deal with, this is something that really shouldn't prevent a customer from moving forward most of the time, okay? So just know that and be aware of it, that we can typically, work with scenarios with customers if they say, hey, I've got tax issues or IRS issues or whatever the case may be. FHA does allow collections to remain open. However, they require what's called a capacity analysis. If the customer has more than $2,000 owed in collections, we have to count a payment against them on those collections. Typically, we're going to estimate 5% of whatever the outstanding collection is as a monthly payment. Disputed derogatory accounts may cause approval problems. If the customer has disputed accounts that are over $1,000, the loan requires a manual underwrite. And we are going to discuss manual underwrites and what that means to you and your customers on the next slide. And then finally, FHA does have a 90-day flip rule. So if you have a scenario where you're going into a house and it's beautiful and it's newly renovated, and your customer loves it, and they're an FHA customer, that should set off warning signs or triggers to ask, okay, is this an investor flip? And if so, how long have they been in this property, or how long have they own this property? If they've owned it less than 90 days, you cannot write a contract until the 91st day after that investor has purchased that property, okay? So just some basic little things that apply to FHA that may not apply with other loan programs, things that are good to know. All right, so manual underwrites, this is a big deal for FHA loans, really for most loan programs, but certainly for FHA loans. There's 2 ways we get a loan file approved. There's what we call an automated approval, and then there's a manual approval, okay? In my opinion, a very good question that you should always ask the lender, whether you know them or not, or whether you're the buyer or the seller or listing side, buyer side, whatever, is this file an automated approval or a manual underwrite? And Jacqueline, good question, or I'm sorry, that was a vet, good question. Purchase or deed recorded, I'm sure that's in reference to the 90-day flip rule, the slide before. It's from the actual purchase date, so the date they actually signed the paperwork to transfer title. So the date that's on the deed, if you pay attention to warranty deeds that transfer title, it'll say this date of, May 27th, but it may not be recorded until June 19th, right? Well, we're going to go off the date on the actual deed, the May 27th, not the recorded date. It's the date they actually signed the paperwork. So that's a good question. Jacqueline, you asked about condos and townhomes and them not being FHA approved. It's a good question. Let me table that. We'll get into some more slides here in a minute where we kind of go over that and then go into more details. But there's lots of reasons for that and what FHA is looking for, okay? So we'll get into that. So like we said, there's 2 ways to get the loan file approved, automated and manual. In a perfect world, every customer would be an automated approval. Okay, automated approvals are the easy way to get a file approved. Basically, what we do is we take a customer's loan application that includes their work history, their credit report, their credit score, money they have in the bank, how much money they make, all that fun stuff. We click a button, we run it through the computer, and the computer basically says yes or maybe. It never really says no, it just says yes or maybe. If the computer says yes, what FHA uses, it's actually called the FHA Total Mortgage Scorecard, okay? If the computer says yes, then the file is approved. The credit is deemed to be acceptable with no additional review. Rent history doesn't have to be verified. We have simplified documentation requirements with regards to, a great example is there are certain scenarios where we need to get 12 months of child support to verify that a customer's received child support consistently. A lot of times the computer will only require us to get 3 months of child support to prove receipt. The guidelines actually say we need to get 60 days of bank statements, but typically a computer approval will require us to only get 30 days worth of bank statements, or 1 bank statement versus 2, which is always nice because the less paperwork we have to deal with, the better. Computers can be very, very aggressive with the debt to income ratio that we get approved. And everybody understands, I hope, when we say DTI, that stands for debt to income ratio. That's how we determine how much money a customer is approved for. We take your total income that you have coming in every month. We look at your total outgo every month, car payments, student loan payments, credit card payments, as well as your house payment. We do a little bit of math and figure out your debt to income ratio, okay? Computers, and we'll get more into manual underwrites here in a minute, but I've seen computer approvals as high as 55, 56% debt to income ratios, which is crazy. That's really, really, really aggressive. And a lot of times computers will approve these loans with little or no reserves, meaning the customer doesn't have to show any extra money left over in their bank or anything extra in order to get the file closed. Other names for automated approvals or total scorecard approvals include things like AE, which stands for Approve Eligible. Some lenders or some loan officers may say, oh, well, I've got a good DU, I've got good LP, I've got good computer findings. All that has to do with, it's just a way to say that the computer has approved the file and we have an automated approval, okay? Elise said, isn't a pre-qual letter just a desktop approval, but a pre-approval letter means they have gone through underwriting? That's a good question, Elise. Unfortunately, there's nothing consistent in the mortgage business between the words pre-qualification, pre-approval, and what that means or what that doesn't mean. The best thing you can do is ask questions to try to figure out where you're at in the process. I've talked to some customers that walk around with pre-qual letters, and they really have not had even a conversation with a loan officer. They've maybe pulled credit. They saw their credit score was above the minimum required. They had a 581 and their minimum was a 580, and they sent over a pre-qual letter. I've seen that. I've seen customers that have gone through everything and they've given more than enough information to the loan officer, and they still haven't been issued a pre-qual letter. So there's nothing consistent there. Generally speaking, a pre-qual letter means that the customer's spoken to the loan officer and the loan officer thinks they have a loan. A pre-approval letter, in my opinion, should mean that the file has been submitted to underwriting and the underwriter agrees that the file is workable and that we have a loan here, and they agree with the loan officer. But again, that's not consistent. I've got access to Homestar letterhead, guys. I can type anything I want on that. Now, I might lose my job if I put the wrong things on it, but you get the idea. I can go through and say, Mrs. Smith is totally approved for a mortgage loan with Homestar Financial, sign my name on it, and unless you know me or unless you've spoken to me, you're not going to know what we've done or how far we've gone through with the process with that customer, okay? But at the end of the day, like we said, most customers, what we want to do is we want to try to get their file automated approved and keep it automated approved. And if you've ever been in that scenario where the lender keeps coming back to the customer, we need more bank statements, need more bank statements, need more bank statements. Typically, the reason they're doing that is a lot of times what will flip a computer from being a yes to a maybe. Remember, the computer doesn't say no, it just says maybe. A lot of times what will flip the computer is the amount of reserves that the customer has. So if originally the customer tells me I've got $8,000 and they only need $5,000 to close the transaction, so they have $3,000 left over, I run that through the computer says yes. We've got all these extra guidelines, all these extra rules that we don't have to follow now. We've got simplified documentation requirements. We're good to go. Well, then when the customer goes under contract, maybe it was competitive. We don't have as much closing costs from the seller. And maybe the customer, when they sent me the bank statement, they just paid bills. So they really only have $6,500. And now they've got to bring $6,000 or $6,200 to close the transaction because the seller's not paying closing costs. Well, that is a big deal to the computer if they only have $300 left over after they close versus having $3,000 left over in their bank account as we close. So a lot of times we're asking for updated bank statements, or lenders ask for updated bank statements to try to catch it after a check has gone in or after they've been paid. So where we can show more money in their name, so where we can maintain our automated approval. So just know that a lot of times there actually is, some rhyme or reason to why we're asking for this stuff or why lenders are asking for this stuff. And hopefully through sitting this class and learning through how some of this stuff works, it'll help you understand why this is the case. And we can kind of encourage our customers to keep fighting the good fight. Let's see what it takes to finalize this and get you into a home. If for some reason we can't get the file automated approved, and some customers just for lots of reasons are not going to be eligible for an automated approval, then we have to do what's called a manual approval or a manual underwrite. Okay, this is the hard way to get a loan approved. There's no other way to put it. What happens is the loan is manually reviewed by an FHA certified underwriter, and we look at everything and ask questions about everything. Okay, we're going to verify at least 12 months of rental history if it's available. We're going to look at the customer's credit report and credit depth. How many years have you had credit? How often have you made payments on time? We're going to ask for letters of explanation for any derogatory credit. It can be really tough to try to get with a customer and help them write a letter as to why they went 30 days late on their credit card 33 months ago. But that's what we're doing. That's what we're trying to figure out. We're trying to show why the bad credit for the customer was temporary, and it's not like this cyclical, consistent thing where the customer just doesn't feel like making their payments from time to time. Also, with a manual underwrite, it requires full documentation. Like we've been through this example before, we might need to prove 12 months of child support receipt instead of maybe 2 or 3 months. And I always zero in on child support because for most people, I can guarantee you, if you go back and look across a year, somewhere in a 12-month period, there's going to be a gap in child support documentation. Okay, whether it's the father that was paying child support was out of work for a couple of weeks, or something happened with his work check, so we had to go meet up and give her cash, and now we can't document the cash. There's always something that makes that difficult. And it's a lot easier for only verifying, 3 months of it versus 12 months of it, okay? So it's just a much more difficult way to get a customer approved, quite a bit more paperwork. All FHA manual underwrites require a minimum of 1 month of reserves, and gifts do not count towards those reserve funds, okay? Compensating factors can be used to justify higher debt to income ratios. Standard FHA guidelines are 31-43. What this means is that 31% of the customer's income can go towards the house payment, and 43% of the customer's income can go towards everything: house payment, car payment, student loans, everything added up. If we have compensating factors that are listed down here, we can increase these debt to income ratios, okay? But these ratios that we can go to on a manual underwrite are not near as high or not near as aggressive versus what we can do with a computer underwrite, okay? The allowable compensating factors for FHA are 3 months of reserves. And again, for reserves, gifts do not count. Little to no payment shock, meaning if a customer makes $1,000 a month rent payment and they're buying a house that's $1,000 a month, that's considered a compensating factor. And then residual income. Let's see here. The residual income, if you want to come and sit through my VA class, we go into more detail of exactly how that works, because VA is the loan program that really came up with and has used residual income for years and years and years. At the end of the day, residual income is really just a cash flow analysis. We take the customer's income, we subtract out their taxes, their monthly debt, their house payments, estimates for utilities and maintenance, and we come up with the residual income, or the amount of money they have left over after they've paid all of their bills and estimates for living expenses. Okay, it's really like a forced budget if you think about it. And what happens is we compare how much residual income they have versus what we deem to be necessary in order to survive. And you'll kind of laugh at these numbers, but these are the numbers we actually use. There's actually a table. This is copied directly from the VA handbook, and they've published it in the FHA handbook. In case you didn't know it, Georgia's in the South. Most customers are going to be getting loans for more than $80,000. So for a family size of one, we'll want to make sure they have at least $441 left over after they've paid all this other stuff, right? All the bills and the debts and the house payments and utilities and maintenance and all this kind of stuff, okay? So it's a really good way, I think, to do budgets for people. You'd be amazed at how many people live their life without a budget or without information like this. But this can be a compensating factor to help us get a manual underwrite approved with a higher debt to income ratio, okay? With that said, though, you know, if we can avoid manual underwrites, we'd rather avoid it. But if we do have a customer that has to go manual and the file gets approved and everything's good to go, let me ask kind of a facetious question. Do you get paid differently on that customer, right? Because it's harder, because the loan's more difficult? Do they, you know, does that mean that you don't get paid and they can't buy the house? Well, no, it's a way to get the file approved. It's a way to get a customer into a property, right? So what I would always encourage you to do is when you're talking with lenders and you're talking with people about, you know, maybe you've met them somewhere, maybe they're, you know, soliciting for your business and they want you to send them some pre-quals, I would bring this up. I would ask, you know, do you or does your company offer manual underwrites? I know companies out there that they do not do manual underwrites on FHA loans. They just don't do it. I know loan officers that work for companies that do manual underwrites, but they personally, as part of their personal business plan, they don't get into the headache with it and they don't deal with it. They don't offer manual underwrites to their customers. Well, there's a whole lot of people in my pipeline right now that are manual underwrites, and you know, they're going to be able to buy a house. We're going to get them closed. And if we didn't offer that, guess what? We wouldn't be doing their loan right now. They wouldn't be purchasing a house. So definitely ask those questions. Make sure you're working with someone that offers these programs, because they really are helpful. It really can be a great way to get people into properties. The other thing to know is that because it is extra paperwork, and I mean, just in this class, you can see I've got 3 slides about manual underwrites versus 1 slide about automated approvals. What I try to do with customers that are manual underwrites is if I take their loan application and I realize it's going to be a tough file and I'm going to have to do a manual underwrite, I typically recommend that customer get in all their paperwork, that we get the file in and totally approved and done with underwriting before we ever issue a pre-qual letter, because it's a bunch of paperwork and we want to make sure we've hashed out any issues or any potential problems we may have on the file before they've got the pressure of earnest money and inspections and contingencies and everything else that's going on when you're actually buying a house. Now, with that said, we've absolutely closed people with a manual underwrite before they've gone through the process, but I encourage them to do that, and I'm certainly going to communicate to my agents and my referral partners what's going on and why we're doing this for this specific customer, because we want to make sure we don't have any issues. And quite honestly, we don't want to make sure we're wasting their time or your time out looking for properties if we run into an issue. Maybe we can't verify their rental history. Maybe we verify their rent history and we find out they went 30 days late 10 months ago or something like that. So things like that can kill a file. It's not quite as bad if it was just upfront versus we're under contract and earnest money on the line and they've already in their mind decorated the living room and picked out paint colors. It can be a bigger blow and a little bit harder sometimes to get that customer back on the home buying train if depending on how that, you know, if we have to decline their file when in the process that happens. Had a question here from Ann. I have a custodian account for my 26-year-old daughter that we never switched over when she became an adult. Would she have a problem using that money for a down payment? Great question, and no, that would not be a problem to use as long as her name's on that account. We're going to count that as her money, so that would not be a problem at all. Good question. Just so you know, guys, FHA does still have in their guidelines what they call a back to work guideline. This came out at the end of the financial crash and the financial meltdown of, from 08 to 2012 or whatever it was. Seemed like it lasted forever. And really no one does these loans. These are not good loans at all. But there is technically a guideline that allows for 1 year of seasoning for all major derogatory items for FHA, including foreclosures, bankruptcy, short sales, all that kind of stuff. So if you see an email or solicitation or an advertisement from a lender that says, oh, by the way, we can do customers 1 year outside of foreclosure on FHA, you should send us business. Technically, that's correct. They're referring to the back to work program. What they're not telling you is that all the hoops you have to jump through, proving income stable now, proving it decreased before, completing home buyer counseling requirements prior to loan application, just all the hoops we have to do this loan program. I think at Homestar, when this came out, we learned about it. And I have to ask some people, because I'm not exactly sure what the final numbers are, but a couple years into this program, and we're a pretty big company, we closed one FHA back to work program. So they really didn't cast a wide net. It's not a good program in my opinion, but it is a great way for lenders to be like, oh, hey, we offer this program that's great for your customers. That's really not helpful for anybody. So just know that it is out there. They're not technically lying to you if they say that they've got a 1 year seasoning loan, but it's not really a loan that anybody or many people at all are going to be able to qualify. Most people are going to be stuck with the 3 year waiting period for foreclosure, 2 year for Chapter 7, 3 years for a short sale. Okay. And again, relative to other loan programs out there, those still are quite aggressive. Secondary financing. FHA does allow secondary financing. This would be, most people, when you hear secondary financing, the best way to think about it is back in the day when we were doing a bunch of like 80-20s, where a customer get 80% loan for one amount of the house and 20% on the second mortgage to avoid PMI and stuff like that. What this means is that FHA does allow there to be a second mortgage on the property in addition to their first mortgage. And this secondary financing rule is what opens the door inside of the FHA loan program for all of the different down payment assistance or DPA loan programs that are out there. Okay. The secondary financing can be provided by government entities, HUD approved nonprofits, family members, or even private individuals. The amount of loan that the customer is allowed to receive changes based off of the source. So FHA allows you to get more money if that second mortgage is coming from a government entity versus if it's coming from a family member, right? So that kind of makes sense. But the whole point of saying that FHA allows secondary financing is to discuss how down payment assistance works inside of an FHA loan, okay? The DPA guidelines, down payment assistance guidelines, are always going to be more strict than your standard FHA guidelines, okay? And the one that I want to touch on real quickly here is Georgia Dream, because that's the big one that we use in this area, and it's a pretty good loan program. It's pretty aggressive, okay? So first of all, FHA has absolutely no income limit, but Georgia Dream down payment assistance does have an income limit. Okay, it's $74,000 if the household is 1 or 2 people. It goes to $84,500 in the Metro Atlanta area if you have more than 2 people in the household. And by the way, guys, this is a household income limit. It's not just people on the loan. So what that means is if I have a husband and wife on the loan and the husband makes $50,000 a year and the wife makes $50,000 a year, even if it's just the husband that's on the loan, because the husband and the wife together make over $74,000, or even if they have kids, if it's just together they make over $84,000, they make $100,000 total between the both of them, they are not going to be eligible for Georgia Dream financing. Okay, so it's household income. It's not just qualifying income or income that's on the loan itself. Anne Marie, yes, is Georgia Dream available? Absolutely, Georgia Dream is still available. We're not really expecting it to go anywhere. We're going to talk more in here, just another slide. One of their loan programs is going away pretty soon, but it's still available right now today. In the metro Atlanta area, Georgia Dream has a maximum sales price of $250,000. Again, remember, for a standard FHA, we can go as high as we want as long as we keep that loan amount under $401,000. Georgia Dream closing costs are quite a bit more expensive. So the total closing costs on a Georgia Dream loan are going to be whatever you typically see, typical closing costs for, say, a $150,000 house. Let's say for a $150,000 house, your standard closing costs might be, I don't know, $5,500 or something like that. For Georgia Dream on a $150,000 house, instead of it being $5,500 in closing costs, it's going to be closer to about $8,500 in closing costs. It's going to be whatever is typical plus an additional 2% of your sales price. So Georgia Dream is more expensive than a standard FHA loan. I always tell, if I can get one statement out there for listing agents or for people to expect, or for what people need to ask for to make Georgia Dream work, you can typically expect them, a Georgia Dream customer, to ask the seller to pay 6% towards closing costs. Okay, try to get that full 6%. All right. Rhonda said, why are people doing Georgia Dream? Great question. We'll get into that here in just a few slides, and we'll come back to it. Okay. So again, max sales price $250. Closing costs are going to be typical plus 2%. I would always expect to ask for lots of seller pay closing costs on Georgia Dream. Georgia Dream has 3 different programs. They have their standard program, which offers $5,000 in down payment assistance. They have their PIN program, which stands for policemen, educators, and nurses. It's really anyone that works in the medical field or in the like first responder industry, or in so like, for instance, people that work at a dentist office or an orthodontist office, they would be eligible for the PIN program. Okay, so they're pretty aggressive in that, but that's what it technically stands for: policemen, educators, and nurses. They can get $7,500. The choice program has to be if the customer themselves, or if someone in their household lives with a disability, they qualify for the choice program. And be aware that these programs can be added on top of each other. So if we have a policeman that has a daughter with a disability that lives with them, that policeman could actually get $10,000 in Georgia Dream funds. Okay, so the standard that anyone can get is $5,000. Think of it as you get an extra $2,500 if you're
putting fresh right back.
Oh,
Barbara, are you there, or did you mean to unmute yourself?
Jay, if you go under manage participants, you'll have a mute all button.
Yeah, I've got it. Yeah, we're good. Thank you.
You're welcome.
So, so you get $2,500 if you're in this field. You get an extra $2,500 if you or someone in your household lives with a disability. However, all of these programs in Georgia Dream eventually will be repaid, either when the customer sells the house or refinances, the $5,000 or the $7,500 or the $10,000 grant from Georgia Dream, which is really just a silent second. It's a second mortgage with no payments. That money will all be repaid. Okay, so it's not really free money as much as it is a 0% long-term loan that, again, you'll have to repay once the home is either sold or refinanced. All right. Now, in addition to these standard programs through Georgia Dream, they're still currently offering what they call the HHF, or the Hardest Hit Fund. This is $15,000, and I'm terrible drawing with a mouse if you haven't figured that out yet. But this is $15,000 in down payment assistance, and this money is actually forgiven as long as the customer lives in the home for a minimum of 5 years. Now, it's only available, the metro counties that this is available in is Fulton, DeKalb, Clayton, and Douglas. It's also available in Muskogee, Chatham, and Bibb counties. These are around Macon and Savannah, in case you're not familiar with counties here in Georgia. But it's mainly these 3 counties here in the metro, or 4 counties, excuse me, in the metro Atlanta area. And Hardest Hit Fund only works on existing homes. New construction is not allowed. And this is the loan program. I think we had a question before. The Hardest Hit Fund is the loan program that's going away June 30th. It doesn't mean that the customer has to be completely closed by June 30th, but they do have to have a home under contract so we can register that customer with Georgia Dream on or before June 30th. The file, I think, technically doesn't have to close until October, if I remember right, or something like that. So anyway, this is the program that's going away, but these standard programs, the standard, the PIN, and the choice, that is not going anywhere. This program, we don't see any reason why these programs will be going away for Georgia Dream. So let me go, I think I've got a few questions. Let's see here. So Sandra, the website, it's tinyurl.com/FHA form. It's just a form you fill out so I can have a record, and I will send you a copy of the slides. And again, we'll post that here in just towards the end of the class. I'll put that link up so people can type it in and have access to that information. Rhonda, you asked, why are people doing Georgia Dream? And I'm sure that's in reference to, well, good grief, if it's expensive, if it's extra closing costs, why do we do it? Well, if we can get the seller to pay those closing costs, that's great. And for a lot of customers, the number one thing that prevents people from getting into a home is the down payment. They do surveys all the time. What's the number one barrier to home ownership? For most people, it is not credit scores. It's not work history or having a job. For most people, it's having a down payment. Now, there's other programs out there to help people, right? There's USDA loans that offer 100% financing. You know, there's for customers that served in the military, there's VA loans that offer 100% financing. But just be aware inside of FHA, because FHA is pretty aggressive with how they do secondary financing, it allows for all these down payment assistance programs to work to help get people into homes. Now, in a perfect world, their loan is going to be cheaper if they have their own money down versus taking advantage of one of these down payment assistance programs. But with that said, a customer that gets into a house with a down payment assistance program is still going to be better off, I think, in the future than if they're not able to buy a house at all, right? Hopefully everybody in this class believes in real estate. I think it's a great investment. I think it's how people build wealth. You get to live there and enjoy the house. Oh, and you build equity and have some, you know, a way to build wealth and all that kind of stuff as a result of real estate. And this is a way to help that dream become a reality for people is, you know, if they can't come up with a down payment or that's a struggle, hey, down payment assistance is not a bad option for folks. Mark asked, if my current mortgage co-granted me a forbearance for 3 months, and then I paid the 3-month balloon at the 3-month mark or before, will that negatively affect my ability to refinance to get a loan at a lower rate with that lender or some other, whether it be FHA, conventional, or other? So Mark, great question. You're basically asking about forbearance in general. For the people in the class that actually work with Maximum One, you know, from our sales meetings, we've been discussing this with some of the stuff. The forbearance guidelines, guys, they're still all over the place. This is still brand new to us, and we just don't know how exactly how we're going to handle it or exactly how it's all going to go down. Long story short, Mark, if you're in a forbearance but then you pay all of that money back, we fully expect you to be eligible to refinance or purchase. Okay. So we do think that will happen, and that's going to be an opportunity that's afforded to you or a customer or anyone else that's done forbearance. With that said, we're still trying to muddle through the guidelines and the rules and everything that FHA is giving us to make sure that we're, you know, that we're doing that right, that we're underwriting those rules right, that we're following all their new guidance and stuff like that. But again, to make a very, very complicated topic that probably one day it's going to be its own FHA or its own CE course, simple, we do think that's going to be eligible, that customers inside of forbearance will be able to purchase or refinance. And guys, on the chat box, if you're not monitoring that, Dana did post a link to be able to get copies of the slides and PowerPoints and things like that. So thank you for that, Dana. All right, so back on this screen here. The other thing real quick, guys, with any down payment assistance program, it certainly exists with Georgia Dream or any of them. I call it be aware of the Georgia Dream infinite loop. So I can't tell you how many times I run into this scenario with customers that call and they want to get down payment assistance to be able to buy a house. And we talk about Georgia Dream, okay? So a customer will call in and they'll, hey, my name's, Bob, and I want to buy a house, but I got to work on my credit. And I'm like, okay. So we pull credit, and let's say they have a 600 credit score. So not terrible, not great. And it's a situation where, okay, well, we've got to get them up a few points even to do like a standard FHA loan. Because like I said, for the most part, we're going to be at a 620 right now for standard FHA. So we get them up to a 620. Well, while they're eligible for standard FHA, they're not eligible for Georgia Dream yet. Georgia Dream requires a 640 credit score, okay? So like, okay, so we keep working on credit, we get the customer up to a 640 credit score. Well, now when they're at a 640 credit score, that's great, but Georgia Dream has their own rules about debt to income ratios. They don't go higher than a 2836 debt to income ratio if you're between a 640 and a 659 credit score, okay? Well, most customers that are working on credit, they finally get up to this 640 and they think, okay, I'm there. I've got my 640 now. I can go buy a house because I can get Georgia Dream. A lot of times their debt to income ratios are going to be 40-45 or 40-50. It's going to be higher than the Georgia Dream limit. So now we've got to keep working on credit, and that's great. But even if we get them up to a 660, it's still not high enough because now the limit's 35-43. You can't go all the way up, like get full approval on a Georgia Dream loan until the customer gets over a 700 credit score. That's when they'll approve whatever FHA will approve per the total scorecard. That's when they'll go up to the 50 or 55 debt to income ratios or whatever the case may be. And it's a catch-22 because the way you have lower debt to income ratios is you have to have more income, right? But what's the problem with more income? Well, remember, Georgia Dream, see if we can clear this. Remember, Georgia Dream has income limits, right? So you get to a point where if you make too much income, you don't qualify. But if you don't make enough income, you don't meet their debt to income ratio rules, all right? So there are a group of people, or there's a section of the population that quite honestly, Georgia Dream doesn't work for them, and it may never work for them. Okay, so being able to know that, being aware of that, I think it's always good to offer solutions to customers, always be able to overcome those objections. If they say, oh, I'd love to buy a house, I just can't come up with the down payment, or I can't do this, definitely tell them, have you looked into down payment assistance? Have you heard of Georgia Dream? Have you heard about this, heard about that? But be aware that there's, just some avenues that Georgia Dream doesn't serve. It typically works best on customers with lower income that are looking to buy a cheaper house, okay? 135, 145, maybe 150. That's really the sweet spot where Georgia Dream works, especially here in about 2 weeks when this hardest hit fund program goes away and most customers are only going to be able to get their hands on about $5,000 of down payment assistance, okay? So just know that's out there. It's, again, it's a good program. We close a lot of them, but it's not, the end-all be-all or the end-all solution to overcome down payment objections for customers. There's other down payment assistance programs out there. We also participate in a fund called Chenoa. Not sure if anyone's heard of that before. Chenoa offers 3 different types of repayment options, or 3 different loan programs. Out of curiosity, does anyone here in the chat remember seller-funded down payment assistance or Nehemiah, things like that, back in the day when we would actually bump the sales price to a home and then have the seller donate money back to this company that they would give to the customer and all that fun stuff? So the down payment assistance programs, those got outlawed and done away with years and years ago. We don't have the seller-funded DPA anymore like we used to. But Chenoa, the best way I can think to describe that to people is to think of it in terms of seller-funded down payment assistance. What happens is Chenoa, guys, no one is in business to just give money away and give it away indefinitely. That's probably a good way to not stay in business, right? So what Chenoa does is they have different types of repayment options. Either they'll offer a grant that doesn't have to be repaid, but then guess what? Your interest rate's 1.5 or 2 points higher than what a standard rate would be. Or they have a program that, yeah, you get a lower interest rate, but then the money will eventually have to be repaid back. They have all kinds of different programs that gets really, really complicated. But at the end of the day, what they're trying to do is they're trying to get their hands back on the money that they've given out to the customer to cover the down payment on a home. Okay, so generally speaking, any down payment assistance program out there is going to have somehow, some way built into it a higher interest rate or higher cost or something. And what Chenoa actually does for some of their better programs, in my opinion, is that the loan program itself is really expensive. There's lots of closing costs that go to Chenoa, and that's the closing costs they use to then turn around and give it to the customer. And the only way that really works is if the seller is paying all the closing costs. So if you think about it, if you just do it through the avenue of closing costs through the Chenoa fund instead of down payment assistance through Nehemiah, you essentially have seller-funded down payment assistance, right? You have the seller giving money to Chenoa that turns around and gives money back to the customer. And as long as we're able to keep that under 6% and make the deal work, that is what, that's how Chenoa works in a nutshell. But it's out there again. Still, if we can get a customer into the house, if we can get them into the property, they're going to build a whole lot more equity than they will if they're renting, right? So again, I'm not against it. I'm not trying to say these are bad programs. I just want you to know kind of the background or kind of underneath the surface that might get advertised, how it actually works. So how are we doing on time? 10:43, we've been going a little bit over an hour. All right, clicking along here. Let's talk about FHA appraisals, guys. For FHA loans, FHA, before we order an appraisal, we have to have an FHA case number. We've probably heard that FHA appraisals stick to the property. The appraisal sticks to the property. The answer is up here on the screen. Normally, if I'm in a live class, I put my hand over the slide so you can't see the answer, and we ask people, how long does an FHA appraisal last for a property? But you can see it right there on the second bullet point. It's 4 months or 120 days. And the way it sticks to the property is through the actual FHA case number. So there's an online system called FHA Connection. I have a login to it. You don't, lenders have it, but it's just for lenders. We get in this system and we register a property address, say it's 123 Oak Street, and we request a case number. Once the case number is on the property, then we order an appraisal, and the appraisal sticks to the case number and the case number sticks to the property. The reason that's important is if the appraisal came in low 2 months ago on 123 Oak Street, and then I get a contract and I decide to pull a case number on that property, the FHA connection, that case number is going to pop up that property already has a case number, it already has an appraisal, and now I have to go get my hands on that appraisal. I can't just order a new one, okay? So just know that that's the way FHA monitors that, and make sure that we're not ordering 2 or 3 or 4 appraisals trying to get the appraisal to come in if we have a challenging appraisal or a situation where value's kind of tight. But again, that case number, that appraisal sticks to the property for 120 days. The property must meet HUD minimum standards, and I've got a whole slide here in a minute to discuss that and what that means. Utilities do have to be on at the time of the appraisal inspection. They're going to check to make sure the power and the lights and the water and the mechanical systems all work and are functional. Any deficiencies that are noted by the appraiser must be corrected prior to the loan receiving FHA mortgage insurance, okay? Now, this is a big deal. This doesn't say prior to the loan closing, prior to you getting paid, it doesn't say that. It says prior to receiving FHA mortgage insurance. We don't submit the file to be endorsed by FHA to get the FHA mortgage insurance until after the loan closes. So we can actually have these repairs that are required after closing. We can do that through what we call a repair escrow, okay? Repair escrows are allowed to correct any deficiencies that the appraiser noted. For standard FHA loans, the escrow cannot be included in the loan amount, and we can only escrow for items that are specifically listed on the appraisal report. All right. There's a lot of lenders out there, guys, that don't offer repair escrows. We absolutely do. I just had a loan close last month. It was actually with Maximum One. And that loan, without the use of repair escrows, that loan absolutely would not have closed. The seller was not willing to do the repairs. that the appraiser had commented had to be done. And we were able to use a repair escrow and get the file to the closing table, okay? Real quick on HUD minimum standards, because that's a question everybody has. People will call and say, hey, I'm at this property. Do you think it will go FHA? Or you're at a listing appointment and you have questions, will it go FHA? Here are the guidelines, okay? What FHA actually says is they say that they want us to correct anything that can affect the health and safety of the occupants, anything that affects the security and soundness of the property. However, they specifically say deferred maintenance is okay, and they use the example of a dripping faucet or like a cracked window. That's fine. That's just deferred maintenance. That doesn't affect the security of the property. That doesn't affect the health and safety of the occupancy of the occupants. Okay, so it's and then there's always questions about appliances, and we'll get to that here in just a second. But the problem with this, guys, is that it's not me or the underwriter that does this. The appraiser is our eyes and ears on the property. So there's a certain amount of HUD minimum standards are kind of whatever your appraiser said they were on the day he went out to the property. Like there's a certain amount of that, because the FHA guidelines does give the appraiser some leeway into what he can comment on or what he says needs to be repaired. But with that said, there's some specific examples inside the FHA manual that will have an appraiser comment on that we've actually overridden his decision or not required that repair to be done before closing, okay? Now, everybody always has questions about appliances, and on that link, it's a little bit further up in the chat when Dana posted it, and like I said, we'll get that link out to everybody. But inside that link, it'll actually pull up a folder with these slides, and one of the documents in there is a form I have that specifically discuss HUD minimum standards. And I think I can actually share that. Let me make sure I can pull it up. Share. There we go. So hopefully everybody can see it's like a Word document here. And these are just snippets of the HUD guidelines. I'm not going to sit here and read this all to you. But just know you have access to this if you want to be able to read it or read. I just pulled some highlights out of the actual FHA manual when it comes to FHA repairs. This first paragraph right here, let's see. Cosmetic, right here, cosmetic or minor repairs are not required, but the appraiser must report and consider them in the overall condition when rating the property. Cosmetic repairs include missing handrails that do not pose a threat to safety, holes in window screens, cracked windows, defective interior paint surfaces in houses constructed after 1978, minor plumbing leaks. So they give you examples of things that are not, that's not what they're looking for. But then if you scroll down, I put on here the things that FHA is looking for, okay? Conditions that require an inspection by qualified individuals and issues that they want looked at include things like standing water against the foundation or excessively damp basements, hazardous materials on site, faulty or defective mechanical systems, if your lights don't turn on or your heating doesn't cut on, things like that. Evidence of possible structural failure, leaking or worn out roofs, possible pest infestations, and then this catch-all statement, any other condition in the professional judgment of the appraiser that warrants an inspection. Finally, on appliances, guys, the standard is that appliances that are to remain and contribute to the market value opinion must be operational. So let's think about what that means. Let's go back and share the other screen here. I'm going to get good at sharing this one day, I promise. Bingo. All right, so we should be back on the slide screen now. What that means for appliances, so a lot of times people say, well, do FHA loans require appliances? The answer is no, okay? Now, if the appraiser comments that there's a very nice commercial grade Viking stove, and because it's a nice $9,000 appliance, I'm going to give that appliance a value on my appraisal of say $2,000, and now that is adding to my overall value of the house, well, then that appliance has to be functional. okay? But if the appraiser is not giving the appliances any value, it doesn't matter if the appliances are there or even if they work. It could be there and not be functional. Now, let me give you another example though. Let's say we have a house where there's no appliances, and where the dishwasher used to be, the person that was there before, they just ripped the dishwasher out, and now I have two wires that are exposed wires that are sticking out in the hole. Well, that's now a safety issue for the home because I've got exposed wiring. You see what I mean? You can solve the problem by installing a new dishwasher, but you can also solve the problem by just putting wire caps or wire nuts over the exposed wiring. Okay, so generally speaking, appliances are not necessarily required. It's not an issue with FHA. That might be different than what you've heard before, but that's the guideline. Again, you saw it there on the screen. If it was too quick, you have access to it through that information, but it absolutely is, appliances are not required for FHA. Now, we typically always have questions about this and standards and appliances and HUD inspections and all that, so let me check. Let's see. Anne-Marie, if there was an appraisal already completed, will the new buyer need to pay for another appraisal? That depends. If the previous appraisal that was done was conventional and the new buyer is going FHA, those are actually different products, so a new FHA appraisal would be required. If the old appraisal was FHA and they're doing FHA, not only will they not have to pay for it, we have to use that old appraisal. Now, let me re-answer that question or be a little bit more clear. If there's already an FHA appraisal on the property and it's not expired, it's within 120 days, then we absolutely have to use that appraisal. As far as paying for it, that depends. If the other company has already been paid for that appraisal, say the other borrower that for some reason wasn't able to close, if they've paid for it, a lot of times that lender will go ahead and release the appraisal to us. If they ordered the appraisal, but the buyer did not pay for it, and they have the appraisal, a lot of times they're going to require us to pay for the appraisal before they'll release it to us, which means now we're going to charge our customer for the appraisal before we'll pay for it for them to release it to us. So it doesn't necessarily mean that they don't have to pay for it, but it could mean they may not have to pay for it. Let's see here. Is there a time period with proof of payment that mortgage insurance can be removed? Harold, great question. For FHA, the answer is no. FHA mortgage insurance remains on the loan for the life of the loan. The only way to get rid of it is to either sell or refinance the property. On conventional loans, mortgage insurance can fall off, but that's not the case with FHA. And in fact, that's exactly the reason a lot of times for customers that are borderline, maybe it makes sense to go FHA, borderline go conventional. A lot of times we encourage customers to go conventional if they can, because of that mortgage insurance feature and the way it can fall off a conventional loan, but can't fall off an FHA loan. Rhonda, great question. Who pays for the repair escrow? That's going to be negotiable, okay? On the transaction we closed last month, we negotiated with and bumped the price of the house for the seller to fund the repair escrow and for the seller to pay for the repairs. With that said, if the seller's not paying for it, then the borrower would be the one who's responsible for the repair escrow, okay? Lisa, good question. What is the max amount of the repair escrow, and does it have to be approved repairs? So yes, the repairs have to be, and that's actually on this next slide. We'll get into more details here in a minute. The repairs have to be repairs that are listed on the appraisal report. Okay, and the maximum amount depends on the property, but for most standard FHA loans, the maximum repair escrow amount is $5,000. Rhonda, the repair escrow, does that cover homes that say as is? Good question. If the appraisal says as is, it means that they aren't requiring any work, and because they're not requiring work, that home's not going to be eligible for a repair escrow. I was told it needed at least a dishwasher and a stove. Who would have known? Yes, that's hopefully that's why we come to these classes and learn about stuff. And I mean, you know, maybe you have a listing, maybe you have something where the people moved out and the dishwasher broke and they pulled it out, and they're, you know, you can then explain to them, no, you don't have to install a dishwasher in order for this home to go FHA. You might need one to be able to sell it, right? But it's not going to be required for FHA. Carol, is mortgage insurance required for USDA loans? Short answer is yes. They don't technically call it mortgage insurance. But the best way to think about it is any loan program at all in existence that is not where the customer is not putting 20% down or more. So USDA is 100% financing, VA is 100% financing. All those programs somehow, some way have mortgage insurance included in the loan or included in the cost. The only exception to that would be if we have a veteran doing a VA loan that receives VA disability. Technically, that funding fee or their version of mortgage insurance is waived. All right. Thank you, Rhonda. Thank you for that comment. Appreciate it. It's I've learned with these online virtual classes, normally when I'm looking at the audience and can see people kind of shaking their head or whatever, it's kind of encouraging. They're like, oh, okay, people are learning something, or they're kind of involved. This, I'm just talking to a wall here, and I hope people are learning something. So I appreciate those details. Elise, do you have mortgage insurance on a home equity fixed? Good question. Home equity lines of credit or second mortgages are entirely different, and those loans typically do not have mortgage insurance. Wrapping up here, guys, on repair escrows, and certainly keep all the questions coming. Just to highlight a few things, like we said, the work must be for items that are required by the FHA. The estimates are not set in stone. What we mean by that is a lot of times the appraiser will go out and say, oh, this and this and this needs to be fixed, and it's going to cost you $500. Well, that doesn't mean that we're maxed out for $500. If the customer gets a quote and it's $850 or $1,100, well, then we're going to put the escrow and the amount of money in escrow that the actual contractor needs to do the work. Depending on the scope of work, we will issue, in certain circumstances, half of the funds up front to buy materials. Okay, if it's a $500 repair, we're probably not going to give the contractor $250 up front. It's just not worth the hassle of cutting 2 checks. But if it's a true, $4,500 worth of repairs, then yeah, we'll give them half the money up front at closing and then release the other half of the money from the repair escrow once we've verified that the work is complete. If there's any extra money left over, so if for some reason a customer has a repair escrow, and let's say it's $5,000 that we've set aside and they only use $4,000 of it to repair the house, they can't get that $1,000 back in their pocket. The $1,000 will actually go to reduce the loan amount of the loan. And then be aware on HUD REOs or HUD properties that you can get up to $11,000 in repair escrows, but for standard FHA loans, it caps off at $5,000. And then how are we doing on time? So we're at 11 o'clock, guys. Dana, that puts us right at about halfway, I think, for the day. So why don't we go ahead and take, what, Dana, it's a 15-minute break? So let's, we'll pause it here, and then we'll get back started in about 15 minutes at 11:15.
Jay, I'm going to take the host back from you.
Sure.
If I can figure out reclaim host.
Yeah, we're both learning the system, and I think you've done it more than me, so I'm jealous.
All right. I don't know if I have the host or not. It's still showing your screen.
Let me stop the share.
There we go. Okay.
Can I give it back to you?
You should be able to. Let me see if I can more. No, it looks like I should be host. Why aren't I host? Okay, there we go. I think I've got it. All right, everybody. Here I have a sign up. Be back at 11:15. Jay is going to stay on to answer questions. When you come back, please type in your name, email address, real estate license number, and phone number if you are attending via phone. All right, I'm going to leave that up for just a minute. You can still type in the chat any questions, or you may unmute yourself to ask Jay a question.
Guys, I learned last night, if you hold down space bar, that's like a way to temporarily unmute yourself and you can ask a question and let it go, kind of like talking on an old CB radio back in the day.
Thank you, Larry, for the instructions. We got kicked off. Do you need to type? Yes, type in your name and information again. We're going to ask everyone to do that after the chat. If you're not able to see yourself during Jay's presentation, that's fine, as long as you can see Jay's presentation. Anybody else have any questions?
Hopefully we answered them all as we were going.
All right.
And guys, I just posted in the chat the link to that form as well. So again, we'll bend over backward to make sure we get you guys this slide information. We're not trying to keep it.
And Jay, I also have it on eagentweb.com under training videos.
Yep. I remember you said you were going to post it there.
Yeah.
Robin, inspection uncovered polybutylene that was not in the disclosure. Can this be part of the repairs from the seller? It absolutely can be part of the repairs from the seller, but it can't. And this is where it gets interesting, guys, when we talk about repair escrows. And that's actually a great question. It brings up another point. So what I'll do, and Dana, maybe you can help remind me, but because I think that's something everybody needs to hear when they get back, in case people are away from their computer or whatever. But let's answer that question when we get back, because we want to discuss the difference between a seller repair versus a repair escrow. That's really what that gets into, and that's a big deal. To answer your question though, Robin, below, technically polybutylene piping is not an FHA minimum standard or a minimum requirement. Okay. In fact, if you're in construction or you know any contractors right now, you can go to Home Depot today and buy polybutylene pieces to repair your home or do, plumbing and stuff with to this day. So in and of itself, the polybutylene is not going to be a HUD repair or a HUD standard. Now, as an agent, it's probably a good thing to protect your customer from it, but it's not it's not just because it's there, that doesn't instantly trigger that that's a HUD minimum required repair.
Jay, I have a question. This is Rhonda Scott.
Sure.
So dealing with FHA, most of the clients I've dealt with has been with new construction or conventional loan. Okay. But now looking at FHA, starting to have clients come in using FHA, a lot of times when you're looking at that price point, you do find homes that says as is.
Right.
And so if it's as is, the seller's already telling you, I'm not doing any repairs. Right. I'm not going to fix anything. So to me, it's a bottom line of saying that that's a house that's probably not going to be approved for FHA loan.
Definitely not. That's a good question, but definitely not. Typically when the home is as is, you're absolutely right. They're basically starting off the negotiation saying that, well, we're not doing any repairs. Correct. Now, and Dana, you've probably seen this as well. In spite of that, I've absolutely seen multiple contracts where the property's marketed as is, and then we come back to them and say, oh, well, you got to fix this, this, and this for it to go FHA, and lo and behold, they'll fix it. Okay? So just because they're saying as is doesn't necessarily mean that they're not going to do anything. They're basically just saying up front, don't come at me and nickel and dime us and pick us apart on property condition. So that's one scenario. The other scenario I've ran into, and this is the one I was talking about before that closed last month, the property was marketed as is. We had some issues. We told the seller, hey, here's what has to be done. And he's like, well, I've already told you I'm not doing this. I'm absolutely not doing these repairs. Mm-hmm. And that was fine. Again, what we did is, I think the customer's under contract for $119 or $120. We bumped the price to $125 and got the seller to fund the repair escrow. You see what I mean? So, so even though it was seller funded, thank you. Even though it was seller funded, and in a way, the seller did do the repairs, but he wasn't responsible. He didn't have to get the people in there.
Right.
He didn't go in, like we just did it as part of the escrow. And that is the way to beat the as-is rule on these listings is if something has to be done to get the customer in the home, just use a repair escrow and have either the borrower or the seller or some combination of them fund it to get to the table.
So let me throw this in. But if the scenario is that the price is already maxed at where my client's at, okay, and then the seller says they're not going to do repairs, how do you deal with that? Because you can't increase it.
Well, then if you can't, so in this case, like I said, the buyer was interested in increasing the price because the value was there.
No, I'm saying if they don't qualify because of the loan,
then they either have to bring that cash to the table,
right?
Cover it, or the seller just has or you get a declination letter due to property condition and you move on. So yeah, I mean, it's not going to solve every problem,
right?
Certainly
that's a good idea.
Out of, not showing the property or just scratching it off the list, because a lot of times those can close.
Okay, thank you.
Yep.
Jay, I just typed in a couple questions just so I wouldn't forget to address maybe when everyone's back. As a broker, I get a lot of questions about the financing contingency exhibits where it talks about if the lender requires that the property be connected to available sewer or water, because those prices in actuality could be extremely expensive. So when people get back, if you'll address that. And then another issue is I get as a broker, the appraisal mandate, the FHA appraisal or VA appraisal, this is FHA class, but mandated repairs. They are not going to be addressed based on the dollar amounts that were negotiated in the exhibit. And we have a lot of agents that are terminating under, they're also not going to get their loan. So the question for the broker answer, but I would love to hear your lender answer on, is this an appraisal contingency issue or is this a financing contingency issue?
That's really funny, Dana, because when I saw the comment here and you were talking, I was like, oh, I see where this is going. And my first response was going to be, well, how would you prefer to handle that on the broker side? Because I'd rather lean that direction than, I can tell you my thoughts on it for sure. We'll hit that. We'll hit that, and we'll hit Robin's question when we get back. Because again, I think it's really important that everybody needs to hear.
And then also, when we get back to, I'll comment from a broker perspective on as is and Georgia disclosure laws.
Yeah, I'm interested because I know my answer, but I know it's going to be a classic. Oh, here you go. It's now your problem.
And just since we're talking, and for anyone that's listening, we had an issue. I had a call yesterday from an agent representing a buyer writing a contract on new construction. The buyer's agent, the selling broker, was getting a bonus from the new construction builder. The selling agent from the selling broker wanted to give the buyer a commission rebate of that bonus back on the closing statement as a commission rebate, but it would show up basically as a buyer credit on the closing statement. Had to get, of course, broker permission letters, and the lender would not accept it. And so the agent comes to me and says, I don't understand. I thought you could do this. And I said, the first discussion was the percentages, because the seller was already making a contract. So we went through that. He went to the lender. The percentages were not over. And he said, I said, well, then that's got to be a branch policy. And it turns out throughout the day, the conversations went all day, and it turns out, yes, that was a branch. That specific lender's policy is they would not allow a commission rebate from one of the brokers to be given as a buyer credit. So that was interesting, because I said, well, that's definitely not an FHA guideline to the best of my knowledge, unless that recently changed.
No, that's mind-boggling, because sometimes you need help from the real estate agents to close a transaction, right? Like something comes in really expensive, or something happens, or the appraisal comes in low and they get less money towards closing. And we all kind of put our minds together and, hey, you give 1,000, you give 1,000, I'll give 1,000, and the transaction works now. But if you just cut that off right at tip right there, that's tough. So whatever. And Dana, I'm going to step out real quick. I'll be right back.
Okay.
Before 11:15.
All right. And I am still on for those of you that are on. If you are coming back, please type in your name, email address, real estate license number, and if you are attending via telephone, we need your phone number too. Interesting stuff, isn't it? And for those of you that are not familiar with Zoom, or maybe if you are familiar, we learn new things about Zoom all the time. Up at the upper right-hand side of your screen, you'll see two little icons, one that has 9 dots all smushed together and one that looks like brackets. If you click on those dots, you know, when the speaker is not sharing the screen, you'll see different views. So if you click on the 9 dots that are together, you can see everybody all in one screen. If you click on the one that looks like it has brackets in each corner, that's what's called the speaker version or something. And basically you'll see everybody else at the top, and you will see this main speaker as the main portion of the screen. So just a couple of ways to view that. Also, we are doing these CE classes through what we call Zoom Pro, where it's a little bit different version of Zoom where we can have more people on and we can have meetings that are longer. But Zoom is free for anybody. You do not have to have a paid account. And so I know of a lot of people that get their own Zoom account to be able to interact with their friends and family via this same technology. And again, you can do that through Zoom, through a free account. It's zoom.us. I'm not a reseller for Zoom. Well, don't we all wish we had stock in Zoom a couple months ago?
No doubt.
And again, for the handouts, let me see if I can go back and find Jay's tiny URL. Have a lot of agents on, and we're so glad that you guys are able to attend us and learn all of this great information. FHA guidelines change all the time, and especially since March, they have changed not only daily, I believe they have changed almost hourly, and I think Jay's going to touch on that a little bit later.
Oh yeah, we're going to get into it. FHA and coronavirus. They gave our program coronavirus for a few days there.
But Jay, you have the vaccine. There's your time.
I've got the, what's it, hydroxychloroquine solution.
All right.
All right, and I didn't think, Dana, the fact of people obviously coming back in and putting their names and stuff in here. So we had the questions were about.
Oh, sorry. Questions were the connecting to sewer and water.
Yep.
Question were repairs, if that's an appraisal contingency or financing contingency.
Yep.
Question was.
Yeah, that's the one I'm trying to find.
Okay, let me scroll up.
All you people typing your names in and doing everything like you're supposed to.
Let me look.
I think I got it.
It was right before my question.
Inspection uncovered polybutylene not in disclosure. Can that be part of the seller's repairs?
Okay. All right, everybody. Thank you guys for typing all of your information in there. All right, everybody. We are going to start back. Again, welcome and thank you for your attendance. Jay, this is great information. FHA is such a huge part of many buyers purchasing properties. And so, you know, it's always awesome. Agents, you guys, you always need to have a lender that you know, love, and trust and can pick up the phone and talk to on a regular basis, because FHA guidelines do change all the time. So you don't have to be the expert, but you definitely need to be knowledgeable about that and then have a great line of communication with a lender. So this information is just really fabulous. Again, please type in your name, email address, real estate license number, and if you are attending by a phone, we will also need your phone number. CE credits will be recorded within 3 to 5 business days after the class. With these virtual classes, we have to put together a bunch of reports to come up with a CE roster that has all the information to make sure you were in attendance for the full time of the instruction. Jay is going to answer some of the questions, and I'm going to give him back the host in just a minute. Prior to that, I am going to launch a poll. And what that is that's what we are using for the CE course evaluation. It is anonymous. So it's going to, I'm going to leave it up from now through the end of class. I can't relaunch it after I launch it. For whatever reason, we seem to have people that have technical difficulties with it. If you can't get it to do, that's fine. Don't worry about it. But basically, it is a series of 5 questions. And you might only see, depending on what device you're on or the size of the device you're on, you may only see a couple of the questions. You will have to use your mouse to scroll down. And once you see all of the questions, you will see a submit button. That submit button does not become active until you have answered all 5 questions. So hit the submit button. Answer all 5 questions, hit the submit button, and you are done. Again, if you mess up, you mess up. I cannot relaunch it or we lose all the information. And so I'm going to launch the poll. And again, you will see it is anonymous, like I said, just like a regular course CE evaluation. And you will see a little slider bar on the right. If you just slide that slider bar down, you will get to all the questions. Again, you can't hit submit until you've answered all 5 questions. That will stay up through the end of class. And make that small. Again, Jay, thank you so much. Great information. And also, Jay, if you will share your contact information as well a couple times. And I am going to make you the host again. Well, let me mute everybody first. And let me find you again. And then I'm going to make you the host. Thank you, everybody.
Good deal. So Dana, I can fill out the course evaluation too, right? We'll talk about.
Yeah, of course.
Of course. If anyone on here doesn't like the course, that's fine. But I hope the poll doesn't work for you. No, keep that joke internal here. But no, guys. So, and when we get to the end of this, I'm gonna post. I've got in the slides at the end lots of contact information with helpful resources, and one of those is definitely my information and my phone number. When I get back to the bottom of the chat here, I'm keeping it up to make sure I don't miss any of these questions. I'll go ahead and type in my phone number as well. And obviously, you know, I think it's a good time to say you're totally welcome to give me a call anytime. Okay, questions in general, something weird, heard about something on the radio or saw something, you know, on social media or someone posting something on Facebook. Guys, chances are we know about it. In case you don't know about Homestar, we, as best we can tell, we close more purchase money business in Georgia than any other lender. Okay, so that's your Wells Fargo's or Quickens or any of them. We close more purchase money business than all of them. And the way we do that is we're pretty aggressive with what we do, and specifically we're pretty aggressive on FHA and with signing up for and being involved with all the different down payment assistance programs and things like that out there. So certainly if you have any questions on it or something comes across, we'd love to answer any questions you have on that and be a resource for you. Before we get into this, we had some questions come through. I thought they were really, really good. We want to make sure everybody caught this. So Robin, you had asked about the polybutylene piping, and I think, I don't want to miss it. It was specifically, okay, the inspection uncovers polybutylene piping that wasn't in the disclosure. Can this be part of the repairs from the seller? So again, a repair escrow where we're actually getting the work done, and the way to think about a repair escrow is what the buyer has to do to the property after closing that the seller wasn't willing or wasn't going to do, okay? And the only time we'll escrow for that where the seller wasn't willing to do it, but it's required to close the loan, is if it's specifically mentioned on the appraisal report, we specifically have to get it done, and again, the seller's not willing to do it before closing. So we'll put money in the repair escrow account, and then the work gets done after closing, and then we inspect the property after closing to make sure that everything's up to speed and we're good to go, okay? If you have a scenario where you negotiate with the seller and he's willing to do work, then even if he doesn't want to do that before closing, let's say he wants to, you find a contractor and he's willing to replace all the polybutylene piping for $1,500, then the seller on the CD can pay money to that contractor just out of his proceeds. Make sense? And that can be done that way. And that's not a repair escrow. That's him paying the contractor on the CD for work that was either done before or after closing. Now, there's all kinds of contractual things, and Dana can get into more detail about that with repairs surviving closing and stuff like that. But if it's something the seller's agreed to do, or something that the seller is paying for, that doesn't necessarily have to be done inside of a repair escrow. Okay, repair escrow is typically for stuff that the borrower is responsible for after closing. Now, the seller can fund the repair escrow, but it's really something the borrower is responsible for, not the seller. Okay, so I want to make sure you understand there's a difference with that. If it's something the seller is willing to do, the seller might say, hey, I'm going to paint this room for you, and they, write a check to $300 to the paint contractor on the CD. That's fine. That's not required on the appraisal, but that's not done outside of closing or after closing, whatever. That's just something the seller's paying for, just like if he would have painted the house before he put the home up for sale. You see what I mean? But think of repair escrows as something the borrower has to do, the borrower's responsible for, and that we as the lender have a hand in, like we want to guarantee that work's done, because again, if this work's not done, we can't get the loan insured through FHA. So there's a difference between what the seller's responsible for and what the borrower's responsible for. No, that's a little complicated, but if you have questions on that, let me know, or you can give me a call and we can go into more details, especially if you have a specific scenario you want to go through. And then Dana, you had asked, so on the FHA financing contingency, it does talk about hooking up public water and public sewer. Technically, yes, that is a FHA guideline. If the home is on a well, or if the home's on a septic tank and public water or public sewer is available, we have to hook the house up to the public water and public sewer. However, the guidelines say we don't have to do it if it's economically infeasible to do so. And I forget what the rule is, but it's some really small, minuscule number. It's like if it costs more than 1% of the value of the property, then we don't have to do that. And in many cases, a sewer tap or a water tap, just the tap before you run the actual line, is more expensive than what it actually costs to, or what the standard would be for it to be economically infeasible. So generally speaking, that is a non-issue on FHA. I don't think in my career I've ever had a scenario where we had to hook the property up to either public water or public sewer in order to get the home to go through. We're able to get it done either with the home being on a well or being on a septic tank. And usually more often than not, it's septic tanks, not wells, that we run into. But that's not an issue at all. It almost never comes up. And we also get this question a lot as well. FHA does not require a septic letter or a septic test or a well test or anything unless the appraiser comments that there may be an issue. So if part of the appraisal inspection, if he notices a funny smell or an odor when he runs the water, or if the appraiser notices an issue with like water flow, like the drains being slow or the toilets flushing slow, then he may comment on that, and then that may trigger requiring a septic inspection or a septic letter. But that's not, just because it's an FHA loan, that's not necessarily required up front. So just know that. And
also,
then,
Jay, before you go on, I believe the GAR and RE forms loan, FHA and VA loan contingency exhibits also have the added sentence that if it is required by that municipality, or I forgot what word they use, but I think that the exhibits themselves also add that additional overlay that if it's required by the city or the county. I'll try to look that up while we're on the course.
Cool. And then Dana, you also asked about, okay, let's say the appraisal. So let's say our sales price is $200,000. The home appraises for $200,000, but it's subject to repairs. And let's say we cannot get an agreement. The seller's not willing to do the repairs. We can't, for whatever reason, we can't repair escrow, whatever. Then obviously you've got a situation where the customer can't get the loan because the property doesn't meet the requirements. So what do we do, or what contingency are we using, or how are we canceling this contract? What I can tell you on my side in that scenario is I have a loan sheet, like a declination sheet that I fill out to decline the loan. And I'm going to check the box that says, we've got all kinds of boxes we can check, not enough income, have assets, stuff like that. But I'm going to check the box that says the collateral is insufficient, like insufficient collateral to get the loan. Basically, the property doesn't work. And now when I give that letter to the real estate agent, I kind of leave that up between her and the broker as to how they use that letter and what they say and what contingency you're using to cancel the contract. I would tell you it's probably more of a, and I would lean to the side of an appraisal contingency, because it's a property condition scenario. Yeah, it may have appraised for the price, but the appraisal in and of itself is not sufficient to close the loan, because the appraisal requires repairs, and it's repairs that for whatever reason we can't do. But Dana, I'm sure you probably have a thought or two on that. How do you guys handle that when you have
well,
that?
As a broker, generally speaking, because we get the question as a broker all the time, if there is an appraisal issue, an FHA appraisal issue that cannot be worked out either with the financing that was agreed upon in the exhibit or whatever, what do we terminate under? Are we because we are going to get, the buyer typically is going to get the loan denial letter from the lender, but what is the proper way to terminate the contract? Is it based on the financing contingency, or is it based on the appraisal contingency? And, generally speaking, we see a lot of contracts where those dates are the same, but they're not necessarily the same. And Jay, I just love your thoughts on this. The way I describe it as a broker to agents is if the denial letter is based on the person. In other words, the lender says, for whatever reason, I don't think you have the ability to pay me back what I am going to lend you over 30 years, then that's a financing issue. The financing issue has to do with the risk tolerance level of the lender for the person. An appraisal issue has to do with the property. So if there's something about the property that does not meet the underwriting guidelines or standards, that the lender is not going to lend money, because if you do foreclose and they have to get the property back to resell, they want to be able to get their money back. So if it's an issue having to do with the property in and of itself, that would be an appraisal contingency issue. If it is an issue having to do with the person themselves, whether it's their credit score or job status or previous bankruptcy or something like that, that's a financing issue. So that's sort of my broad brush stroke of describing how you know what to apply for, because you are going to get the lender denial letter, but it's based on an appraisal issue. Do you think that is an accurate way of describing it?
Yeah, absolutely. And I think that lines up, with me being the guinea pig and going first to try to answer the question. Yeah, the way I see it is, if there's information on the appraisal that we can't fix that causes that loan not to go, that should fall under the appraisal contingency, even if the home appraised for value or even more than the value of the sales price. Normally, when we think appraisal contingency, we think in terms of it was under contract for 200, but only priced for 195, and we can't close the deal. That's 99% of appraisal issues, right? But there, you can have the other issue of, well, the value's there, but we have to fix this hole in the wall, and we have to fix that, and the seller's not willing to do it. I don't want the liability of you going to do it. The customer, for whatever reason, doesn't have the cash to do the repair escrow. The seller's not willing to fund the repair escrow. We've got just an issue we cannot overcome, you know, whatever it is. And that it's the appraisal ultimately that is preventing that customer from getting financed. So I would tell you that falls under the appraisal contingency. And the reason, guys, that's a really big deal is because you have to remember on your contingencies, you have a set deadline for your financing contingency, right? 14 days, 15 days, 21 days, whatever it is. But technically your appraisal contingency, or better yet, your escape clause language that's in VA and FHA loans that basically says if the appraisal doesn't work, then you don't have to move forward with the loan and you're always allowed to get your earnest money back. That's a big deal. If we're going off the appraisal contingency, you could do that the day of closing and your buyers still get their earnest money back, versus if it's financing contingency and you're outside of those dates, then the buyer would not be protected from losing their earnest money. So, but I would fall under the side, Dana, and I think I agree with you, fall under the category here of if it's because of the appraisal, whatever the scenario is, then that should be an appraisal contingency issue.
And just one last comment, and then I'll let you get back to your presentation, is agents, you guys, if you're working with the buyers and it is because a repair issue can't be worked out, like Jay said, appraisal contingency for protection of buyers' earnest money on FHA, VA do go through day of closing. Financing contingency is times, but you guys, you've got to get with your lenders and make sure that the loan denial letter reflects that it is something to do with the property, rather than I just can't finance this person for whatever reason. Because if you're outside of your financing contingency and that's what the loan denial letter is, you are going to jeopardize that buyer's earnest money unless that lender properly fills out that loan denial letter. Thank you so much, Jay. I'm going to mute myself and let you go back on with your presentation. We are still looking at questions. If you guys want to ask Jay any questions in the chat, continue to do so. And that's it. Thanks, Jay.
Sounds good. Thanks, Dana. And then I'm gonna go ahead and share the screen, but while I'm pulling this up, I think I saw one more question come across. Robin, I think you asked, is there a specific place where we can see all the repairs or something? It was something like that, and I apologize. I was going through quick. So if you need to retype it, just do so, and we'll do a better job of answering. But again, we kind of hit on the fact that, you know, HUD minimum standards are kind of subject to whatever your appraiser says they are when he gets out there. But the actual repairs that are required on the appraisal report will be listed on the appraisal. Now, a lot of times it's buried down in page, 22 or 23 or whatever, but there will be a list that's available. And you said a few pipes were already replaced. That's why I was wondering, what about furnaces with rust flakes? It depends on if you have a specific scenario where the appraiser's saying that or talking about, rusty furnaces or something like that. I can tell you that I don't see anything in the guidelines that explicitly states that rust on a furnace is an FHA required repair. But again, there may be an issue where maybe the furnace isn't working as well as he thinks it should, and comments, maybe this is the problem. I have no idea. But that's, like I said, the list of required repairs, if there are any on the appraisal report, will be listed on the appraisal report. But like I said, it's typically buried on like page 37 or something like that. All right. So getting back into it, guys, hopefully you can see the PowerPoint screen again. And then just to kind of break up the monotony here, and because I'm curious, tell me what in the chat box, for those of you that can get to it real quickly, what's your favorite sport that you're looking forward to getting back to seeing once they lift this ban and sports come back to us? Just out of curiosity, I'll give you my answer as well. And I figured that's what it would be. Lots of soccers, lots of baseballs. got some basketball, SEC football. Yeah, we've already talked about that. Go Jackets! But no, I totally understand. I really hope they figure out the baseball thing. I'm a huge baseball fan. I played all through high school, and if they can't figure out a way to get comfortable making, $2 million a year instead of $5 million a year, owners and players or whatever, I'm gonna be a little bit frustrated. But hopefully we'll get back to normal and being able to watch baseball games on Sunday afternoon sooner rather than later. All right. So moving along, everybody, we want to talk about basic FHA loan structure here. This is for a standard FHA loan. Generally speaking, what we do, and for this scenario, we're going to assume that the appraised value is going to be greater than or equal than the sales price. So we're assuming the home actually appraises. The down payment is 3.5% of the sales price. So we take the sales price minus the down payment, and that gives us what we call our BLA, or our base loan amount. All right. Yes, Ray, go Jackets. I'm with you. Go team. So we get our base loan amount. Then the upfront mortgage insurance premium, and remember, this is the percentage that you actually put in your financing contingency on an FHA loan, is 1.75% of the base loan amount. So we take the base loan amount times 1.75%, and that gives us what we call our upfront mortgage insurance premium. Then our base loan amount plus the upfront mortgage insurance premium gives us our total loan amount. Now, to make this a little bit easier, let's put actual numbers with it instead of letters, make it more math and less algebra. Let's just say we have a sales price of $100,000 and customers putting 3.5% down. 3.5% is $3,500. That means your base loan amount is $96,500. You take 1.75% of $96,500, so your upfront mortgage insurance premium is $1,688. So the customer actually walks away from the closing table with a loan amount of $98,188. This is important because I can't tell you how many times I field questions from customers and they're like, wait a minute, if I'm buying this house, I'm putting this much money down, why is my loan amount higher? It's a good question, but the answer is typically always the upfront mortgage insurance premium. Is this money that we're rolling into the loan to cover this part of the FHA mortgage insurance is included in the loan amount. And remember, you actually mark that on your form, that amount will be included in the loan. Now, you're welcome to put the customer will pay it or whatever, but if the customer wants to pay it, be aware that whatever their cash to close is, in this example, it's going to increase by about $1,700 if they're trying to pay that mortgage insurance premium out of pocket. Again, most people are going to just finance it to keep their cash to close low, because again, the biggest benefit of FHA is that it is a smaller down payment, and most of the time we're trying to keep the customer's down payments as low as possible. Let's see, got a couple questions. Rhonda, you said the appraisal contingency on the RE forms require a date, but I'm hearing the AP goes to closing, the appraisal contingency goes to closing. That is correct. Now, this isn't true for conventional loans. I know you mentioned you do a lot of conventional stuff. Conventional loans are different, but for FHA and for VA loans, they have what's called an escape clause. And the escape clause basically allows the borrower to get their earnest money back no matter what, if the appraisal comes in lower than the sales price, or if you have an issue with the appraisal. So that goes all the way up to closing. Now, hopefully a customer wouldn't do this to a seller, but you could potentially get all the way to closing date, show up at the closing table, and turn over a copy of the appraisal report where the appraisal came in low, get your earnest money back, and walk away from the transaction. So that is true for FHA and for VA.
Jay, let me just comment on the RE forms. On the purchase and sale agreement of the RE forms, there is a fill in the blank for a time frame for an appraisal contingency. However, on the RE forms, if a buyer is getting an FHA or a VA loan, you need those exhibits. And you guys all know from Real Estate 101, an exhibit will supersede the purchase and sale agreement. And on the FHA loan exhibit, in the RE form as well as in the GAR form, it has the amendatory clause, which is the appraisal contingency, and there is no date. So on an FHA or VA loan, especially, you have to use the exhibit, which supersedes purchase and sale. Appraisal contingency goes through day of closing because there is no date. And on both the RE forms and the GAR forms on those on those government insured loans, it also has verbiage that says these exhibits control over any conflicting language in the contract or any addenda. So you cannot special stipulation out anything having to do with an FHA, VA, or USDA loan. Those government insured loans take precedence over anything that the buyer and seller agree to as a special stipulation in the purchase and sale agreement.
Sounds good. So, and yeah, Dave, just to reiterate that, there's nothing you can do on the listing side. I've seen agents try to do it. There's nothing you can do or any language you can type to supersede that escape clause. That language is always the end all be all in the contract. If the home doesn't appraise, the customer can get their money back. There is no time frame on it. That's just part of doing government loans. That's a rule they have, and it's been there for years and it's not going away. Good question, Anne-Marie. So if the buyer has the cash, can they pay the upfront mortgage insurance premium? Absolutely they can if they have the cash, but normally that's not the best or the most efficient way for the customer to use that money. They obviously, all that does is it keeps the loan amount lower. They could use that money as more down payment. They could use that money to buy the interest rate down. They can use that money to have in their pocket as reserves. It's not very common for the customer to pay the upfront mortgage insurance premium, but to answer your question, yes, they can do it. It can be done. And then Freeman, I guess it's Lester Freeman. If the buyer pays the 1.75% upfront, is there still a monthly mortgage insurance premium? Yes, there is. What happens is you have to remember the customer is always paying the upfront mortgage insurance premium. They typically just pay for it by including it in their loan amount. But the fact that they pay for it either by including it in their loan amount or by paying for it cash at the closing table, it doesn't matter. The monthly mortgage insurance is still there and will still be part of the FHA loan. Real quick, guys, and the reason we hit this structure here is I just want you to see the difference or how it works for HUD REOs. Those homes, there's not really a lot of them on the market, but I have a sneaking suspicion we're going to start seeing a few more foreclosures and FHA foreclosures. Unfortunately, coronavirus and people losing jobs and things like that. Unfortunately, that has negatively impacted the people in our community. They're a little bit lower wage income earners on average. If you look at national data, we can kind of prove that. And those are people that are more likely to have FHA homes and loans, and those are people that are more likely now to be susceptible to foreclosures and short sales. It's just the world we live in right this second. So I have an inkling that may tick up, and then what that's going to create is some opportunity maybe for your buyers to purchase these homes. So I just want to cover some basics real quick for HUD homes or HUD $100 down loan programs. First of all, as far as the guidelines go, we have absolutely no changes or differences in our from standard FHA underwriting versus HUD foreclosure underwriting. When I say we here, I'm talking about Homestar. I know for a fact there are other companies out there that have extra rules and overlays if the customer's buying a HUD foreclosure. But again, we do everything exactly the same. Income verification is the same. Credit rules are the same. Customers can get gifts. All that kind of stuff is still the same. The down payment for a HUD foreclosure is $100 versus the standard 3.5% down. And the maximum base loan amount is the lesser of the appraised value or the sales price minus $100, okay? And then on HUD foreclosures, they do allow repair escrows up to a maximum of $11,000. What that is, it's a $10,000 repair escrow with a 10% contingency. So that's how you get to the $11,000 number. And on HUD foreclosures, that amount can actually be financed into the loan. So we can roll that into the price of the home, okay? The biggest misunderstanding with HUD foreclosures is always the cash to close. People get online, they say, oh, it's HUD $100 down, I only need $100, right? You've got to account for closing costs. Other out-of-pocket costs for HUD foreclosures include things like earnest money, because HUD still requires earnest money. It's still a standard contract, well, it's not a standard contract, it's a HUD contract. Customer is typically responsible for turning on utilities. They're responsible for de-winterizing the property. They're responsible for paying for the appraisal. So there is going to be some out-of-pocket expenses to buy this home, just like there would be buying any other To give you an example of how cash to close works, let's assume we have a scenario here where the home, and again, guys, I keep these numbers low and small just to make the math easy. I realize people aren't really buying houses for $100,000 anymore. But again, it kind of keeps the math easy to kind of see how it works. And then any of these numbers, if you want to take it to like a $200,000 sales price, just double the numbers. Makes sense? Like the numbers we're looking at, if you double it, then that should get the numbers pretty accurate or pretty close. So we're assuming that it appraised for 105, but the sales price came in at $100,000. Your base loan amount is going to be $99,900. Okay. Let's see here. So yeah, $99,900 right here. Let's assume for a minute that the total closing cost and prepaid expenses are $4,000 and the seller's only paying $3,000. Well, then what happens is the customer is responsible for their $100 down plus the $1,000 difference in cost. The fact that the total amount's $4,000, but the seller's only paying $3,000, so they can purchase this property legitimately with $1,100 out of their pocket. Or for a $200,000 house, it'd be about $2,200 out of their pocket. Quite a bit cheaper than your standard 3.5% down, which is going to be, $3,500 plus your closing costs. Correct? So that's one example. Oh, wrong button. There we go. All right. Moving along here, let's take an example. This is actually the exact same example. This used to be different. The rules for HUD foreclosures used to be really, really complicated. So I had a lot of slides on it. But again, the take-home message here is the home doesn't have to appraise for more as long as the appraised value and your sales price work. Okay, then the customer is responsible for the $100 down plus whatever closing costs they're responsible for. And in this example, it's still $1,100. Now, in this example right here, we have an appraisal issue, okay? We have actually, no, we don't. This is just gonna be the same thing. 105 is the sales price. It doesn't matter that the price went up a little bit. It's still just $100 down. You've got a $1,000 difference between what the seller's paying and what the actual costs are. So again, the customer is only bringing $1,100 to the table. Their base loan amount's $99,900 based off the sales price. They can't, oh, I got to fix this slide, guys. It's bogus. It's actually, the base loan amount's actually $104,900. But again, their out of pocket's still going to be $1,100. But this is the slide I really wanted to get to, because you can have appraisal issues on HUD foreclosures just like you can with anything, okay? If the sales price is 100, but the home only appraises for 98, we have a $2,000 appraisal issue right here. We still have the closing costs that the customer's responsible for, all right? So we've got a $1,000 difference the customer's responsible for in closing costs. But in this case, you've got the $100 down plus the $1,000 in costs plus the $2,000 appraisal issue. So the customer's going to be $3,100 out of pocket. Just a little side note or something to be aware of with HUD foreclosures is that once you're under contract, HUD absolutely does not renegotiate the contract. You can't go back because of an appraisal issue and get more money towards closing. You can't go back and ask for a reduction in sales price. The only thing you can do is cancel the contract and rebid on the property again, okay? So just know that, be aware of that. They do not renegotiate the contract once it's done. But again, it depends on the customer. If the appraisal is not too far off and there's still less money out of pocket and they have the wherewithal to do it, they can absolutely move forward with the contract. I totally understand though not wanting to buy a property if it's not, if it didn't appraise. So you would just have to cancel the contract and move on. So anyway, that's the highlights real quickly on the HUD foreclosures. Any examples or any questions about HUD foreclosures specifically before we move on? Chat looks pretty still, so that is good. Next part of this class, guys, I want to talk about some recent changes, or it's really not recent anymore, but in my mind, it still feels recent because it was such a titanic shift in how we underwrite and how we do FHA loans. Several years ago, FHA moved from their 4155 handbook to the 4000.1. Okay, the 4155 was a staple in the mortgage business. In fact, that was language in loan officer circles and in mortgage circles. that was the language we used all the time. People would ask a question and we would say, well, have you checked your 4155, or what does the 4155 say? That was just part of everything that that we did. You know, the 4155 was the FHA handbook for years and years and years. The FHA or HUD retired the 4155 several years ago, and they replaced it entirely with the new 4000.1 handbook. And what makes this handbook interesting is it has two completely separate set of guidelines. They have total mortgage scorecard guidelines, and then they have manual underwritten loans or manual loan guidelines. So even though, and we talked about this already, where you have automated approvals and manual approvals, the best way to think about it, in my opinion, is yeah, they're both FHA. It's, you know, the same program, but you really have two separate loan programs with HUD. You have half of the book that's for automated approvals, and you have the other half of the guideline, the other half of the book for manual loans or manual approvals. Okay. Now, there's absolutely no way to discuss every single change that took place when they retired one handbook and went to the other. But what I want to do is I want to focus on the most significant things, the things I think have been most influential with how we look at and understand and underwrite FHA loans as a result of this change. And the things that I put here in parentheses have the highest likelihood to kill a transaction or to blow up a deal. And to this day, we still run into this, even though we've been living in 4000.1 handbook world for the last 4 years, I think it's been, maybe a little bit longer than that. It's almost 5 years now. We still see things come up and files that get transferred to us from other lenders where the mistake that was made, it's a mistake that would have worked on the old handbook, but doesn't work now, or there's some issues we have to work through with the new handbook. Okay, so the things that we want to cover as part of this class are FHA case numbers. We want to cover student loans, and we want to cover just some various other things that they've included and added as well. So the first one is FHA case numbers. And if you'll remember, we have already discussed FHA case numbers as part of this class. Remember, case numbers are assigned to the subject property before we order an appraisal. And for years, that was the main feature of a case number. It was how FHA kept up with the kept up with if an appraisal had been ordered on the property, and if that appraisal was still relevant, and so where we couldn't order multiple appraisals and try to make value come in if it had come in low. The whole point of the case number was to track the appraisal and make sure we were using the FHA sanctioned appraisal on the property. Okay. Now, and that date is actually a typo, it's September 2015 when this came out, not 2005. I wasn't in the mortgage business in 2005. But as of September of 2015, moving forward, so you've lived in this world whether you've known it or not, case numbers are way, way more important. Basically, every date of concern in the loan guidelines is based on the case number date, okay? And the reason that's important, or why that's a big deal, is think about every guideline, everything that we've discussed in this class so far, okay? We said foreclosures, you have to wait 3 years. Well, 3 years till what? Like what's 3 years? 3 years until I apply for a loan, 3 years until I close on the loan. Bankruptcies are 2 years. We've said if a customer gets overtime or commission income, we need to see that it's been verified for 2 years. We have to, if a customer works 2 jobs, we have to have 2 years of job history of working 2 jobs. Well, 2 years until what? And that's been a complaint for years with FHA is lenders, everybody applies these guidelines differently. So FHA came out and they finally gave us a date, and they said, okay, the date that we're going to go off of is the case number date. Well, this is a big problem at times in an FHA loan. And let me give you an example that actually happened a couple of years ago with a maximum one agent, so a lady I was working with. We had a scenario where she was the listing agent, listed the property, did a good job, marketed it, got it under contract. I had the buyer. The buyer came to me. The buyer had a previous short sale, but I knew about the short sale, and we were 3 years outside of the short sale. We were barely 3 years outside of the short sale, but we were 3 years outside of the short sale, and they could purchase the home. Well, when we went to order the case number to order the appraisal, we found out that there was already a case number on this property the customer was buying. and that case number had been ordered by a previous lender. The appraisal had come in low. The seller had gotten upset about the whole process and fired her listing agent. The new listing agent for Maximum One took over. She had no idea that that had happened. And the problem was that that case number had been ordered back in time when my customer was no longer 3 years outside of their short sale. Make sense? It would be like if a customer had a short sale that ended on May 31st, I go to order a case number on today, say June 10th, but then I find out there's already a case number on the property, and that case number was pulled back on May 15th. The problem with that is that that case number being pulled on May 15th, well, now magically my customer is not 3 years outside of their short sale, so they're not eligible for FHA financing. You see what I mean? Creates a really interesting problem and a real interesting conversation with a customer where you have to say, okay, Mr. Customer, I told you were approved for an FHA loan, and you are, and I told you to go find a property, and you did a good job, and I can lend on any property at all in the state of Georgia that you're interested in, except the one that you found, because there happened to be a case number in place that disqualifies you from qualifying because of your previous short sale. Now, what we did in this scenario is once we got the case number transferred to us, we looked over the appraisal. We weren't very happy with it. The appraisal really was problematic in a bunch of different areas that I was surprised they couldn't have a problem with originally. And we ended up canceling that case number and ordering a new case number. So not only did we get a new appraisal, but we got a new case number that was now dated after the 3-year short sale, and we were able to close the loan. But it's just it's definitely something that's a big deal now that used to not be a big deal prior to the new guidance and the things that came out a couple years ago. So now before we order case numbers, we have to really pay attention and really watch out for things like past foreclosures, bankruptcies. We're looking at overtime and stuff like this that are on a specific timeline for FHA loan to make sure that stuff works. Good question. Doesn't the appraisal stick for 4 months? Seems like forever. I agree. I can come up with scenarios where the appraisal sticking to the property actually helps us. And I can certainly come up with scenarios where the appraisal sticking to the property actually hurts us. But that's not a magic number. All the documents in an FHA loan are good for 4 months. So there's always a 120-day rule, whether it be pay stubs, bank statements, and appraisals and other documentation just gets lumped under that 120-day time frame. So case numbers are a big deal, and we really have to watch out for that now for customers as a result of the new guidance. Student loans, this is a big one. We always have questions about student loans. The old rule years ago used to be that if the student loan payment was deferred for 12 or more months after the customer closed, then we didn't have to count a monthly payment on those student loans for that customer. Now, the issue here, or the challenge with student loans, actually before we get into that, good question, Rhonda, can we get the case number before making an offer? No, not really. We need an executed contract before we get a case number. And I will tell you that the case number thing is really not a big deal for most customers. It's only a big deal in that scenario that I gave you, where we have a customer that is just barely outside of the time frame or the rules based off an old bankruptcy or foreclosure or something like that. That's usually the biggest problem we have. And even then, since I put these slides together and things have happened and HUD realized this is a problem, they have made it easier to cancel case numbers. When we run into these types of scenarios, it's still a little bit difficult, and it still absolutely can cause a problem, but it's definitely not anything that we need to hold up an offer or hold up a contract on, in my opinion. So like I said, student loans used to be if they were deferred for 12 months or longer, we didn't have to worry about a monthly payment on it. The newer rule, when the guidebook came out, FHA said, well, you have to count a payment. The problem with counting a payment, I don't know if you have a student loan or you know someone that has a student loan, is there's all kinds of payment options for student loans. And I've had customers with $150,000 in student loans, and their monthly payment is $15 a month or $10 a month because they're on a really good income-based repayment plan. And FHA said, wait a minute, that's not what we were trying to do here, because FHA's problem with it is most of these student loans are federally subsidized, federally backed, Department of Education student loans. And we have customers that they would defer their student loan, they would buy a house, they would get an FHA loan, and then because they had a house and had a mortgage payment, they would go back to the student loan company and say, well, see, I've got this big mortgage payment, so I can't afford to pay back my student loans. So they were creating this cycle of people never making a payment on a student loan ever. So FHA finally came back and said, okay, we have to count the greater of either the current payment or the reported payment on the credit report, or 1% of the outstanding loan balance, okay? And guys, I can tell you every week in the mortgage business, every week, I pull a credit report with $100,000 or more in student loans every single week, okay? Lots of people have lots of student loans, and there have been some new rules and regulations that have gone into place, and there are some things I think Congress is finally trying to do to alleviate this problem, because it is definitely a problem in society. But with that said, there's a lot of people out there with lots of money owed on student loans, and there's a whole lot of people that you can't count. I mean, you got to think 1% of a $50,000 student loan is $500, or it's an extra $500 a month we count against this customer. There's not a lot of people out there that if they're not making a payment, or they're used to making a $10 a month payment, on paper, they're not going to qualify if they actually have to make a $500 or $1,000 or $1,500 a month payment on that student loan. Okay, so we see it all the time. Now, the solution with FHA is right here. So a lot of times we go ahead and get what we call a fully amortized loan payment, where we prove that, okay, if the customer were to make a $350 a month payment for the next 30 years, they'll pay off the $100,000 in student loans, and I'm allowed to use that in lieu of the 1% of the outstanding balance. But just know and be aware, the best way I can explain this is there's a whole bunch of people that went to bed the night before this guideline went into place that could qualify for a loan, that woke up the next day and could not qualify for a loan. So student loans are a big deal. We do have other solutions. Actually, conventional loans are a little bit more aggressive right now than FHA when it comes to student loans and different things that we try to do to get people into homes. But just know that student loans it's an issue. If you're working with customers, you're probably working with someone that has student loans, and something that we have to pay attention to when we're doing a loan. Yesterday, just to give you an example, I pulled a credit report. Now, the guy was a pharmacist, so he does make good money nowadays, but he has over $300,000 in student loans that he took out in order to get his pharmacy degree, or to get through schooling through pharmacy school. So again, we see it all the time, and it's definitely something to be aware of, and good to know, I think, some of the rules and how it works for FHA, because the key here is we have to count these payments, even if it's not the actual payment the customer's making. And sometimes customers get frustrated because they're like, well, I don't understand why I don't qualify, or I don't qualify for more house. You know, I can afford more. Well, on paper, FHA says you can't afford more. Some other things to know about the recent FHA guidelines and things that have happened since the new guidelines came out. FHA is really wary of what we call undisclosed mortgage debt now. This would be an example where a customer maybe buys a house and they get owner financing, so it's a private mortgage and it doesn't show up on a credit report, or a customer had a mortgage that was tied up in a bankruptcy. A lot of times when a mortgage is tied up in a bankruptcy, that mortgage quits reporting on the credit report. But the let's see here, the mortgage will quit reporting on the credit report, so it's not, we don't actually see the mortgage payment history on credit. That can lead to lots of issues getting the loan approved, and in many cases it requires what we call a manual downgrade, where even if we get an approval finding or an automated approved finding in our system, we still have to manually underwrite that file. Good question, Ms. Cook. Please explain again what fully amortize the loan means. So that's back here on student loans. So the best way to explain that is the 1% of the outstanding loan balance is just the general rule of thumb that FHA is giving us in order to calculate a monthly payment that we need to qualify the customer with, okay? And for a lot of customers, if they only have, say, $15,000, $20,000 in student loans, a lot of times they can qualify for a house, or still qualify for the house they want, at 1% of that outstanding balance, which on a $20,000 loan would be $200, or $200 a month as a monthly payment that we count for that customer, okay? Now, if let's say the customer doesn't qualify at $200 a month, but we can do the math and say, okay, and you can go online and just type in like loan calculator or like a car payment calculator. It'll pull up a calculator for you, and you can type in, okay, $20,000 at 5% or whatever the customer's interest rate is on their FHA loan across their remaining term, meaning that let's say they have 60 months or 80 months or 120 months left on their student loan. We can figure out what that payment would be, and instead of counting 1%, we can count what's called a fully amortized payment, meaning the monthly payment they would have to start making and continue making every month in order to pay the loan off in full by the end of their term, okay? So that's what a fully amortized payment is. And in a lot of cases, the fully amortized payment winds up being less than the 1% of the outstanding loan balance that we would typically just calculate, okay? So now sometimes the fully amortized payment ends up being more expensive. So sometimes it doesn't help us. But generally speaking, it's a rule or something out there that we can do to try to increase or help facilitate the customer getting approved for an FHA loan if they do owe money, or specifically if they owe big money on student loans. 30-day accounts, this is something that we're still, in my mind, I'm still getting used to. 30-day accounts are things like your American Express cards or Diners Club cards. It's cards that don't actually report a monthly payment on credit. The idea is that you charge money on the card and then you pay it off at the end of every month. What we used to do on FHA loans is we would show that the customer had enough money to pay the account off. Say they owed, most people that have that, it's usually people that run businesses and they run like a balance on their American Express. And their credit report would show a $3,000 American Express limit with a $3,000 a month payment. As long as we could show that they had $3,000 in their bank account, we could assume that they would use that money to pay the card off, and we wouldn't have to count a payment against them at all on that account. Now what FHA says is, if we can't go back and prove that they have paid that account off in full for the last 12 months, then we have to count a payment against them on that account of 5% of the outstanding balance. Again, it's not really a big deal. Hopefully it doesn't affect our ability to qualify, but for some customers, they might run a $10,000, $15,000, $20,000 a month balance on their American Express card, and 5% of 10 grand, that's a lot of money that we have to count against them, and it could affect their loan approvability. And it's just it's not something that we're used to, or in my mind, we're still getting used to doing when we see these accounts. Authorized user, the example there is, I have a credit card, but I add my wife as a authorized user on the card so she can charge on the card as well. If we pull credit in her name, we're going to see an authorized user. It used to be we could just delete that account. We just don't count it. Well, now FHA says we have to prove the other customer has made 12 months of payments on time on that account. If we can't prove that, then we still have to count that authorized user payment against our customer, okay? So it's just different things, little quirky things that in our FHA world we used to do reflexively that we can't just reflexively do anymore. Good question. There was a question on that 1% student loan. Do they have to start making the payment before the loan is approved? No, FHA guidelines do not say you have to start making the payment. I know for a fact there are lenders out there that require the customer to start payments on those student loans in order to qualify. That is an overlay. That is not an FHA rule. We're not going to require that they start making payments to qualify. And then finally, guys, a big one here that we see more often now than anything is what we call identity of interest transactions or non-arm's length transactions. FHA has always had rules where if you're buying, if you're buying a house from the builder, like if you're trying to buy a new construction house and you've rented out from the builder, there's different rules. They've always had rules if you're buying a house from, like if it's company owned. And the reason I say builder is we ran into that a lot where a guy who worked for the building company would try to buy a new construction house that was owned by their company. That's a non-arm's length transaction. That's an identity of interest because maybe you have a scenario where people aren't going to try to get market value for the home, or it's not a true upfront scenario with purchasing the property because the people know each other. It applies for like family, like when you're purchasing a house owned by your aunt or uncle, that can create an identity of interest or a non-arm's length transaction. As part of the new rules, what FHA came out with is they've now said that a landlord-tenant relationship is also a non-arm's length transaction, okay? So what that means is that if you have a scenario where a person moved into a house, been renting it for a year, 2 years, or 3 years, or whatever, and they now want to purchase that house they've lived in because they already know the landlord, because they've been a tenant of that owner for the last 2, 3, 4, whatever years it may be, then that creates an identity of interest, and FHA says you can't get full financing. You can't do 3.5% down. You have to do 15% down. You have to do 85% loan to value, okay? Now, there are some rules and some overlays and stuff like that where we can avoid this. But another piece of it is, and I don't think I have it on the slides, the other thing that FHA has said is, remember, they don't want any more seller-funded down payment assistance. And the way they, one of the things they were concerned with, and something we saw a lot of back, we don't see it so much anymore, but we saw a lot of this back during the financial meltdown and when property prices were really depressed and stuff like that, is you had scenarios where people would try to buy a house. They would say, well, I'd love to buy your house, Mr. Owner, but I don't have money for a down payment. And the owner says, hey, no problem. Why don't you go ahead and move in? You know, my $200,000 house, you would normally be paying $1,500 a month to live here. I'm only going to charge you $500 a month. Okay. And then, but what the owner would tell the tenant or the potential purchaser is, instead of paying me $1,500 a month, only pay me $500, but save that $1,000 a month. Save your money for the next, 5 months, 6 months, whatever it is. And then when you've saved up enough money for your down payment, then go back to your lender and purchase the home from me, because now you have your down payment. It was kind of a backward way to give what we call seller-funded down payment assistance, right? The seller was basically paying for their own down payment for the buyer. They were just doing it in the form of having lower rent or below market value rent. So what now FHA says we have to do is, when we have this scenario where a customer is renting a house and they're trying to buy the house they've rented, we have to determine what the fair market rent value is, and whatever the customer hasn't paid in fair market rental value, we have to have them pay the seller that money back before they're allowed to get financed on the property. So it really creates some issues doing FHA with like lease purchase transactions and stuff like that, okay? So again, you've lived in that world for a few years, whether you knew it or not. The only solution I have for this when we run into it is to maybe have the customer move out, like literally move in with their mom and change their license and say, well, I don't live at 123 Oak Street. I live at 456 Elm Street. And now I want to go back and buy 123 Oak Street. Does that get us past the guideline? I'll be honest with you, I haven't ran into this enough where I've actually gotten to test that. What we typically do is we end up taking the customer with a different loan program. We end up taking them conventional. But just know there's all kinds of little quirky stuff like this that can pop up and will pop up on FHA financing. Anthony asked, if a student loan is deferred, it's not going to be a problem with FHA. Anthony, no, that's not a problem as long as they qualify with that payment, either a fully amortized payment or 1% of the outstanding student loan balance. Another thing that changed recently with FHA, and it's still there, and again, for most of these customers, we're going to take them conventional if we can. Vacating a primary residence, meaning the customer already owns a home and they want to move and go to a new home, and they're going to rent out their current home. Excuse me. If we need rental income for that person to qualify, so the house they're moving out of, if they have to lease that out and I have to use that income in order for them to qualify for the loan, then I can only count rental income if they're moving a minimum of 100 miles away from the house that they're vacating, okay? They also have to have 25% equity in the property, and we're only allowed to use 75% of the monthly amount of the lease agreement as qualifying income. Okay, so just be aware that FHA a lot of times is not going to be our best option for a customer who's vacating a primary residence. The good news there is, though, most customers that are vacating a primary residence, they've already had a mortgage typically for a few years. They typically have better credit, and they can typically qualify for conventional loans in addition to FHA loans. But FHA is by far the most restrictive when it comes to vacating a primary residence that you intend on renting out. And Elise, you asked, if you take the lease purchase situation with conventional, can they do 3% down? That is a great question. There are all kinds of different programs for conventional loans with 3% down. But the short answer is yes, if the customer is below income limits, they can do a 3% down conventional loan while still owning a property. And what happens in a lease purchase refi? Ms. Freeman, can you be a little bit more specific or maybe give me a few more details? I don't know what a lease purchase refinance would be. You can't refinance the property unless you own it. And if you own it, you own it. It's not a lease purchase. You know, they're either leasing the property or they own it. And guys, let's talk a little bit about the world we live in now, FHA and COVID-19, or the day FHA caught coronavirus. I like to talk about it. If you paid attention at all in the business at all, you probably know that the financial markets went absolutely crazy in the beginning of the realization that this coronavirus thing is real, and we're shutting down the NBA, and we're shutting down life and society, and we're quarantined and doing everything that we've done over the last couple of months. When all that happened, markets went absolutely bonkers crazy. And then you had the government step in and try to help. You probably saw they cut prime rate. Prime rate doesn't really have much to do with our mortgage rates, but they also announced a big situation where they were going to buy a whole bunch of mortgage-backed securities, okay? And that really impacted our mortgage markets, really affected our interest rates. But there was a genuine concern, and it makes sense, right? When you quarantine and you shut down, the entire economy, it seems like, there was a genuine concern that mortgages were not going to be as a great credit item. We were concerned that people were going to default on their mortgages. And we've never lived in a world where we had quarantines, and never lived in a world, at least in recent history, where we've done anything like this. There was a concern that we were going to make loans to people and they wouldn't be able to pay the loans back if they couldn't work or they got fired, or we just didn't know what was going to happen. So across the board, literally overnight, you had lenders tighten guidelines. Okay, Homestar did it. Everybody I know did it. There's still some lenders out there, I think, that won't go down below a 680 credit score on all of their government lending products, whether it's FHA, VA, USDA, what have you. That was during the middle of that. We did go from a 580 to a 620. Again, technically, we can probably get a really, really good 580 done, credit score done, if we've got really good compensating factors. But everybody tightened guidelines. Pretty much everybody, the liquidity to buy FHA loans started to evaporate. I don't know any lender right now that's lending on manufactured homes or mobile homes with FHA financing. We can still get it done conventional, but that program literally dried up overnight. And the reason was there was a genuine concern that people weren't going to be able to make their payments, that these mortgages weren't going to be as good of a debt instrument as they had been historically. And in case you didn't live during the financial crisis, the biggest lesson you can glean from that is that when people don't make their mortgage payments, we have problems, and mortgages have to be profitable in order for companies to lend. And there was a genuine concern that the mortgages we were making weren't going to be profitable. Then you add in the issues with the government saying, okay, you can defer or you can go into forbearance on your mortgage. What does that look like? Who's going to be responsible for that? Who's paying interest on this money that we have lent out? We've guaranteed interest to certain people for investing in our company for us to lend this money out. If you're telling the end the person who actually has the mortgage, they don't have to make payments, who's covering that? Just all kinds of questions that have popped up. Now, since then, over the last couple months, because all that really happened back in mid-March, I would say, is when things just went absolutely bonkers haywire. Over the past couple months, things have settled down a lot. Obviously, we know Georgia's back open and doing business. Obviously, Braves aren't playing yet, but things are getting a little bit closer to normal. You can go out to eat now and stuff like that. With that said, we're still, as an industry now, not Homestar, just as an industry entirely, mortgages and mortgage companies are still reeling a little bit from everything that happened and how quick it happened. And we're still trying to get our footing and understand what all the new things mean, whether it be mortgage forbearance and how we're going to approve these customers, how we're going to stay profitable in our servicing portfolios for people who aren't making payments, people who've been told by the government you don't have to make payments for 3 months, 6 months, 12 months, whatever the forbearance may be and however long it's going to last. And all these things affect our profitability. And what has happened, if you're really paying attention, the cost of mortgages in general right now have gone up. Now, fortunately, we're really not seeing that because interest rates have gotten so low that it's just not, all things held equal. If the market would have stayed the same, the customer back before coronavirus that was paying 4% for their mortgage would probably be paying closer to 4.5% or 5% right now. What that means too, though, is because of the extra expense in closing a loan today, customers who are getting, 3.5% or maybe even 3% interest rates on some of their loans might be getting those same loans at 2.75 or 2.5 if we didn't have all of this uncertainty and stuff like that still in the market. So just know that the short answer is when markets go crazy and things happen, super fast like this, everybody tightens guidelines. Credit always gets a little bit tougher to get. And like I said, the stability we've had over the last month and a half, 2 months has been wonderful. It's been exactly what our industry needs, but we're not out of the woods yet. And the hope is that, as we stay stable, hopefully more people make payments. Hopefully, we had a phenomenal jobs report on Friday where the unemployment rate actually went down. Now we can have a whole political discussion as to whether or not we think that's actually accurate or if they're going to revise those numbers differently next month and what have you. But just be aware that at the end of the day, people have to make their mortgage payments for mortgage companies to be profitable. And you want mortgage companies to be profitable because you need to be able to lend money to the next person that wants to be able to buy. Hopefully we keep pulling out of this. We keep going the same direction. Hopefully we have better treatments and cures and, whatever vaccines and stuff for this stuff sooner rather than later. But with that said, be aware that if we have a second round of coronavirus or a second quarantine or whatever, certain prognosticators are predicting, it absolutely is going to affect our financial market, and we're absolutely going to see mortgages tighten again. Okay. So just know with crazy change typically comes more strict credit requirements. And we do have some more questions here. At least if you take the lease purchase situation with conventional candidate 3% down, we covered that. Robin made my kids pay any amounts out of hope. I love that. I love people not taking out student loans to get an education. That's wonderful. Candace, can you refinance if you are on the deed and not on the loan? Absolutely, you can refinance if you're on the deed but not on the loan. In fact, on a conventional loan, you don't even have to be on the deed. I could go apply for a loan, Candace, and refinance and get my name as a lien on your home if you're willing to sign the deed at the closing table to allow me to do that. So no, you do not have to be on the deed or the loan to refinance, with the caveat if it's a rate and term refinance, meaning that we're just refinancing the current balance that's owed on the property. If we're doing a cash out refinance, then you have to have been on the deed for a minimum of 6 months, but you never have to be on the loan in order to have to refinance. So real quick, guys, let's hit a few highlights here on FHA 203K financing. This is this loan program has become more and more popular, at least not popular, not popular in the sense of a lot of people doing it, but more popular with lots of questions about it as HGTV and all that kind of stuff has become more prevalent, and you have more and more people that want to walk into a house and say the word shiplap and it'd be worth $1 million more than it was before they walked in and said shiplap. Generally speaking, though, on a 203K loan, the best way to think about it is that your project cost replaces the word sales price. Okay, so a customer that wants to buy a house, say it's $100,000, but it needs $50,000 worth of work. Well, now their FHA loan is based off them qualifying for a $150,000 project. $100,000 purchase, $50,000 on the renovations. The people that do the renovations, we're going to do our due diligence. We're going to make sure that the contractors are licensed and insured. There's not anywhere near as many of these loans on the market as there are standard FHA loans. When you have less investors and less people doing them and less liquidity, you always have more overlays. We have a 640 minimum credit score on 203K. Fortunately, that hasn't changed during Corona world, so we're still at the 640 minimum. We have a maximum 55 debt to income ratio, and at Homestar, we do not allow sweat equity. And what that means is, generally speaking, we're not just going to allow a random customer to tell us, oh no, I'm going to do all the work, and I'm going to use the fact that I've done work on the property as my equity or as my down payment in order to qualify for the house. Now, we do have exceptions to that. If we have a scenario where maybe our customer works for and is a part of, say, an HVAC company, and he tells us that, hey, I can repair the air, I can repair the HVAC system, I can install a new one way cheaper than market value because I can get it in there for $900 and normally be $4,000 or something like that, then absolutely we can use that difference as part of that customer's equity in the property. There are scenarios where we can do it, but generally speaking, most people that do this loan, or let me rephrase, most people that ask about 203K or ask about renovation financing, they walk in with the attitude of, my dad showed me how to install carpet and I know how to swing a hammer and I'm going to do all this work myself. And that's not acceptable. We want to make sure that we're bidding out the work and budgeting money for an actual professional contractor, professional company to get this work done. Okay. So, at the end of the day, 203K is a phenomenal loan. Some of the best deals I've seen people get as far as stepping into equity and stuff like that is with a 203K loan, with doing renovations and building renovations inside the loan. What I will tell you is that if there's not a minimum of $10,000 worth of work, the extra cost of 203K is not worth it. 203K loans are higher interest rates and they do have higher closing costs. Okay. Robin, yes, the contractors do have to be licensed and insured. So it is a good loan program. However, I typically recommend it for people who are at least familiar with or have been in the industry or know someone that's been in the business of renovating homes, because most people just don't understand that you don't, get a whole house painted in a commercial break. And that's really the biggest thing that we combat is we combat just the culture and the TV shows that we have that show renovations, and they don't show you all the problems that those people actually run into, just like anybody else renovating a home. In fact, we know one of the guys that if you guys know, I think it's HGTV Flip or Flop Atlanta, Ken Anita Corsini. I did business with him for years, several years ago, and I kind of know the inside scoop with how those renovations work and knew it before I ever saw a show when he got tapped to be on HGTV. And seeing how they did it versus me knowing the background story on some of these properties, I was like, man, they can make TV tell any story they want to tell. It's just super interesting. And they do a great job of telling a story. But just know that 203K is not for the faint of heart. You need customers that have free time, can go meet contractors on the property, can go make stuff happen, can get bids, can get people to fill out forms, because there's a lot of extra paperwork. I mean, think about a standard mortgage. There's a lot of work involved with the mortgage company when we verify income and assets and credit. And we do that all day, every day on every file. Now you're getting the mortgage company involved on now you're getting the mortgage company involved in the renovations. So yes, it's just a lot of paperwork. And Robin, you're right. He did go to Georgia Tech. Actually, when he got his degree, he went back to Tech to get his master's degree. And I was working with him when he was doing that and going to school on the side. So super interesting guy, super nice, really like him. Danielle, you asked, can you get a 203K conventional loan? Great question. Technically, no. 203K, remember, is the subsection of FHA that allows for renovation. So this is the FHA version of a renovation loan. Fannie Mae does have a renovation loan. They call it, can't believe it just left my mind, I will think about it. It will come back to me before this class is over. But they have a separate program that's a renovation loan for a conventional loan. Like I said, there's not anywhere near as many investors and people like that invest in 203K versus standard FHA. There is almost nobody that does the Fannie Mae renovation loans. It's not HomePath. HomePath was the one that they did for back in the day when they had Fannie Mae foreclosures all crazy, but they retired that program a while ago. Homestyle, that's it. Thank you, Dan. Homestyle renovation loan through Fannie Mae. So yes, it's out there. We technically close them. Those loans are unbelievably expensive. And to be honest with you, we typically are trying to find other avenues for customers to pay for renovations outside of Homestyle. Okay. Rhonda, good question. Is 203K in Georgia Dream? Yes, technically Georgia Dream will allow 203K financing. I will tell you as a loan officer, but out of respect and love to you and your client and the seller and everybody else in real estate, I will encourage you never, ever, ever, ever to do that. 203K is hard enough as is. 203K, and then you add the complication of Georgia Dream. I mean, you know, we're asking for problems there. I would not recommend it. I tell you, that's a loan I'm not going to enclose. I'm either going to talk the customer out of it, or I'm probably going to bow out of that transaction. And I like a good challenge, but that would just be an absolute nightmare. Oh, let's see here. Moving on, be aware FHA does offer a energy efficient mortgage. Actually, you know what? We're at 12. For some reason, I was thinking we had to go to 1, but we're running out of time here. Energy efficient is not a big deal. Let's hit this, guys. Resources to know. This is information for you guys. HUD Home Store is where you can find the HUD foreclosures that are available. You can get information on HUD.gov and FHA.gov. They have a great frequently asked questions section where you can type in questions and get answers. Also, this number right here, write this down, save it in your phone, 1-800-CALL-FHA. This is a 1-800 number that's actually designed for you to call and ask questions, especially if you get an update from a lender that doesn't make sense. You can call and verify guidelines, verify stuff. These people are super, super helpful. My phone number is on here, 552-1513. That rings my office. You can get me. You can get someone on my team that they can flag me down if you have questions and need help with, things like that. So those are some good resources for you. And then finally, remember, if you'll fill out this form for me, tinyurl.com/FHA form, we'll get a record of that, and I'll make sure you get the link with the slides. Dana's posted it a few times. Hopefully everybody's had access to it. And certainly, guys, I'll hang out for a few more minutes if you have questions, and I appreciate you sitting through the course. Sorry we went a little bit over today. Thank you, Rhonda.
So
I appreciate that comment.
Awesome, awesome information. All right, you guys, Ask Jay, any final questions, either in the chat or you can unmute yourself. If you're not asking a question, please keep yourself muted so it doesn't get too loud.
I like to think we did such a good job, there's no questions, but it's probably not the case. Yes, link for the handout is here. Like I said, you can go to tinyurl.com/FHA form. Should take you to a real simple Google form, fill it out, and then I'll get a record of it and I'll make sure you get that information.
And again, CE credits will be recorded within 3 to 5 business days. Just check your own GREC login, your own agent login through GREC, or check with your qualifying broker. We will not contact you once they have been credited. Jay, we still have a bunch of people on. Any questions, anybody? I have one. I need to leave. All right, just type in any questions. They're going fast, or just unmute yourself and ask.
And thank you guys for the compliments. I really appreciate it.
I was trying to say thank you, but I can't get anything through chat.
We can hear you, Rhonda.
Okay, well, as long as he know I'm saying thank you and I enjoyed the review of the class.
Well, thank you so much. I appreciate that.
Mm-hmm.
Candace, you said, can you explain again about the refi when on the deed but not on the loan? Absolutely. So, and again, guys, you have to be careful here because every loan program is a little bit different on the rules, and we're not going to create a CE class about refinances because that's really just not terribly relevant to real estate agents in general. So every program is a little bit different, but most people that are refinancing, we're actually typically trying to refinance them into a conventional loan because most people have pretty good equity right now and we're trying to get rid of or drop that mortgage insurance. On a conventional loan, there is no seasoning requirement. There's nothing out there where you have to be on the deed for any certain period of time to refinance unless you're doing a cash out refinance, okay? So in theory, you could have a scenario like I had a loan that closed last month. The wife was the only person on the loan and on the deed. The husband obviously had lived there for years, but he technically lived with his wife rent-free according to the paperwork. When it came time to refinance, it was better for him to do the loan in just his name than us to put the wife on the loan. And we were absolutely able to refinance that loan into just his name, even though he was neither on the deed nor on the note. He wasn't on the mortgage, he wasn't on the deed, he wasn't on any of it, but we were able to refinance him onto that house because there's no seasoning requirement, there's no rule that he has to be on it in order to refinance. The only exception to that would have been had they wanted to take cash out. Now they didn't. They went from like a 4.5% interest rate to like a 3.5% interest rate, I think it was, or something like that. So because of that, they weren't trying to take any cash out. It was no problem. Now, if they wanted to pull cash out with some equity that they had in the property, he would have had to add himself to title and been on title for 6 months. But then that would have been the only rule. As long as he was on title for 6 months, he would have been able to do the refinance to take cash out then. I think someone asked, there's my phone number, the 678-552-1513. Website is homestarfc.com/Jay.Alexander. And you can see all my information, drop me a note, you know, all that kind of stuff.
Hello, Jay.
And I think I had missed a note. Yes, ma'am. I'm sorry. Go ahead.
This is Rob. I wanted to ask you about the 203K. I'd asked about being a quote unquote professional.
Uh-huh.
The reason I asked is I've got my brother-in-law and 2 nephews that have done construction their whole entire life. That's all they've done.
Okay.
But they're not like, they haven't went and got a degree for something professional. On that 203K loan, I can't use them to do renovations on a home.
I mean, so they don't care. They've been doing
like
it
their
for
profile or something like that.
Insurance or anything?
Well, I mean, like, would having their profile, or you know, like they've renovated kitchens for other companies and stuff like that, having that, would that suffice in trying to get a 203? Because I was thinking about doing that myself, but getting them to do the work, and then we eventually may start a business that way.
Yeah, no, you absolutely. So generally speaking, we're looking for license and insurance, but a lot of times for 203K, if the project's really, really big, it's usually easiest, and we didn't really get into this in the class, we can, but again, 203K is complicated enough. It could probably be its own CE class for 3 hours, and quite frankly, I have no desire to teach that class. But what you would typically do in a scenario where you're doing a whole bunch of work and there's people you want to use and stuff like that, the way we facilitate it is we have all the work bid under like one general contractor who's licensed and insured, and then they work for him or through him to do like the kitchen work. You see what I mean? But then in theory, there'd be other stuff too. So there's ways to beat it or work around it with anything, with any loan program, quite honestly. And that's how we would do that.
Okay. All right. Thank you.
Yeah. And guys, I think I saw a question. I just remembered it for whatever reason. Someone had asked, like, what's the interest rate right now for an investment loan? That's going to be a conventional loan. I'm quoting investment rates in the low 4s. I mean, 4.1, 4.2, depending on credit and stuff like that. But I mean, rates are really, really low right now. Long story short. Any other questions?
All right, Jay, if you will give me back the host, or let me see if I can take back the host. Okay, I am the host now.
You're the host.
Hostess with the most. It's still showing your screen. There we go. All right, everybody. Thank you guys so much. We appreciate your time and attention. Jay, great class information. And Jay will send you out that information when you go to fill out that form, and we posted it several times. Please check out the calendar, and we look forward to seeing you guys on more classes. Thank you, everybody.
Thanks, everybody. Appreciate it. Have a good day.